This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
We're addicted to the parlor game, the Fed, the monetary ballet.
Where do you see opportunities in a fixed income space here in 24?
With Lisa Mateo on markets.
AI affecting demand for cloud computing.
And Michael Barr with news.
Another legal setback for Donald Trump, this time across the pond.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so check us out there. Scope out Bloomberg Podcast, and that's where you'll find us there. We're also want to welcome our listeners in New England on all new Bloomberg 92.9, Bloomberg's Boston's #1 source for news on the FM dial, Bloomberg 92.9. Tom Keene out today, some top secret mission perhaps, I'm not sure, but not to worry. Alix Steel sitting in for Tom for the next 3 hours. How about that?
How about that? But then you lose me for 2 hours after that. So
oh, I do?
Yeah. They
okay.
don't let me do 5 hours in a row. That's just you, Paul Sweeney.
All right, well, that's yet to be determined who will be there at the 10 o'clock hour. We'll play that by ear. Lots happening here in the marketplace. We got the JOLTS data coming up. That's always a fun data point to look at. I'm always like, who are these people that are just not working? They're just out of the job market. Why are they not back in the job market? The JOLTS typically runs 4, 5, 6 million. Mm-hmm. We got as high as 11 million during the pandemic. We're now running around 8.1 million. I'm just, who are these people?
I like the quit rates, right?
Yes.
So like who's leaving and going where and what that signals and then what the money market for that is.
Exactly. So we'll get that coming up. So we got some economic data we'll break down. Kristina Hooper's going to kick it off today. She's over there at Invesco. She's got a good view of these markets. Nika Gupta, Director of Macroeconomic Research at Wisdom Tree. She's going to join us on Hall, the economic stuff. And then we hauled in Mandeep Singh into the studio today. No mailing it in. Mandeep Singh has to come in here.
He never mails it in.
No. And he said, Mandeep, what's going on with NVIDIA? What's going on with these tech names? Is it just a kind of a little bit of a pause in the tech rotation? So we'll get some thoughts there. But first, let's go to Lisa Mateo. She's here. She's always here in our studio. Lisa, what do you got for us?
You got it. And right now we've got futures in the red. Stocks posted their worst day since the August 5th market meltdown, with the S&P 500 falling more than 2%. So right now we'll check in with S&P futures down 0.4%, 25 points. We have Dow futures down 0.1%, 76 points. Nasdaq futures down 0.8%, 154 points. Tech hit the hardest, yet NVIDIA racing $279 billion in a record one-day wipeout for a U.S. stock. Right now those shares down more than 1%. That trickle-down effect felt in the chip sector. Intel, who's also struggling with growing financial issues, they're down nearly 1%. Chip equipment maker Applied Materials down 1%. Same for Taiwan semiconductor manufacturing. The pain spread to that biggest tech companies looking to kind of reshape the economy with AI. You have Alphabet down 0.5%. Same for Microsoft. Apple down about 1%. To the bond market, we have the 2-year yield 3.83%. That's down 3 basis points. The yield on the 10-year 3.81%, and that's down 1 basis point. Commodities, have to point out WTI crude, it fell below $70 a barrel. Right now WTI crude at $71.14 a barrel. Bond market, we just did that as well, and we'll get back to covering more in just a bit. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. All right, I have my all-time list of overeducated guests, and our next one is certainly on this list. Okay, so Kristina Hooper, Chief Global Market Strategist for Invesco. Undergraduate degree from Wellesley. That's good. I have a lot of respect for that. Then she gets a master's in industrial relations from Cornell. Not sure what that is, but I know it's good. MBA from NYU. Okay, I think we're overdoing it there a little bit. And then, not only on that, she gets a law degree from Pace University.
Oh my God, a law degree? I did not know this.
I did not know that either. So
I knew she was the smartest person I talked to.
I know, exactly. So we appreciate getting a few minutes of Kristina Hooper's time. Hey, Kristina, what did you make of yesterday's trading? Was it just kind of the market kind of blowing off some steam here? What did you make of that?
I think there are a lot of jitters right now. And I think a lot of it has to do with psychologically the fact that now markets are very confident that the Fed is going to cut. Bad news becomes bad news. You've heard it before, but it really is true. And so any signs that this economy is weakening more than we had initially thought is cause for a sell-off, especially among stocks that are more closely priced for perfection. And that really is the story that we saw yesterday, and we may very well see it again today.
So it's a bad news is bad news situation when it comes to economic data and then the equity market, but it's still a slowing, not a downturn, right? So I'm trying to understand the distinction then when we do have some sort of big equity move.
Well, it is a slowing, but keep in mind, we don't exactly know how this monetary policy tightening plays out because of the long, variable, lagged effects of monetary policy. And so that is the underlying fear that gives markets pause and jitters when we do get, for example, a disappointing manufacturing PMI, or we see earnings warnings from companies, or whatever the case may be. So I think that right now markets are walking on eggshells. And we could very well see this leading up to the Fed's meeting, and again as we lead up to the election. So this should be, I think, a more volatile fall, one where there's more downside potential. But I think ultimately we end 6 months after the start of easing. I think we end in a better place because that is an environment that's supportive of risk assets.
In the near term, Kristina, how are you positioning, or how are you suggesting to your portfolio managers at Invesco that they position themselves for, I don't know, the next 3 to 6 months, where, as you say, there may be some volatility?
Well, I think there has to be, what we've been saying to clients is it's really important to have diversification. Sometimes you can look at periods of time and decide it doesn't make sense anymore to be well diversified among equities, fixed income, and alternatives. But this is a reminder that diversification helps to smooth out volatility. And so having that exposure outside the US in the equity space. And keep in mind that there are many, many investors who probably are overweight the US simply because they're not rebalancing frequently enough. And we've had such a strong run up. There are many clients that are likely overexposed to large caps versus small caps, overexposed to growth versus cyclicals, overexposed to equities versus fixed income and alternatives. So this is an opportunity, I think, or a reminder at least, to be well diversified, but also don't be afraid of equities. Don't be afraid of risk assets. I look to 95, 96 as a guide. That was the last time the Fed was actually successful in avoiding a recession when it tightened. Now, there are some conditions that are very different than they are today. But my key takeaway is that easing provides a tailwind for risk assets. Now, there wasn't much of a tailwind in 95, 96 because the Fed only gave 75 basis points in cuts after hiking rates 300 basis points. We're looking out on expectations around 200 basis points in cuts over the coming year. So we could have a far more powerful engine, far more fuel to support risk assets this time around.
I have a question. Which degree did you like getting best?
I actually loved getting my MBA in finance. That was my sweet spot. And I love TAing. I did it at night while I was working during the day, and I found it to be a virtuous circle.
Half of Wall Street has their MBA from the Stern School at NYU, I'm convinced.
Yeah.
I mean, it's unbelievable
Not you,
what a
though.
program. No, I went to Duke, but they have a just fantastic program. Kristina, what do I do here with fixed income? Do I sit with my 2-year Treasury at close to 4%, or do I try to take some credit risk?
So I think you do both. In the spirit of diversification, when I look at the numbers, for example, in that 6-month period after the Fed began easing in 95, high yield did very well. But I believe very strongly that history can often rhyme, but it's not repeating itself. So, in my opinion, I think it's important to have some exposure to investment grade, and I also think there's a place for treasuries. I would go longer duration in this environment, locking in these higher yields. But this should be an environment in which we could see a variety of different asset classes perform well, as we did in that 6-month period following the Fed's start of easing in July of '95.
All right, Kristina, thank you so much for joining us. Kristina, we always love getting a few minutes of your time. Kristina Hooper, she's the Chief Global Market Strategist at Invesco, giving us some thoughts on these markets. Again, we got some economic data coming today. The JOLTS opening today at 10 a.m. Alix won't be here with me, but I'll somehow figure out how to report it myself.
You'll do a great job. I have
figure it
confidence
out.
in you.
All right, with our news in New York City, here's Michael Barr.
Thank you very much, Paul. Alex, Lisa, the Justice Department has unsealed charges filed against 6 senior members of Hamas's leadership for their alleged involvement in the kidnapping and murders of Americans during the October 7th attacks on Israel. A DOJ official says that the charges were kept under seal since February because the U.S. was hoping to take Ismail Haniyeh, the Hamas leader killed in July, into custody. 3 of the 6 that are charged are now dead. Attorney General Merrick Garland says the U.S. will pursue suspects for the rest of their lives.
We will continue to support the whole of government effort to bring the Americans still being held hostage home. The charges unsealed today are just one part of our effort to target every aspect of Hamas's operations. These actions will not be our last.
AG Merrick Garland. With the presidential debate less than 1 week away, both candidates are working to get out their message. Donald Trump is focusing on the border. Vice President Kamala Harris is focusing on the economy with a stop today in New Hampshire. Foreign Minister Dmytro Kuleba, one of Ukraine's most recognizable faces on the international stage, has submitted his resignation ahead of an expected major government reshuffle. Russian strikes overnight, meanwhile, killed at least 7 people in the Ukrainian city of Lviv. It's being described as a slow-motion landslide. California Governor Gavin Newsom has declared a state of emergency in the Seaview neighborhood of Rancho Palos Verdes. A landslide is making it a challenge for utility companies to serve their customers. Most of the homes in the area have gas and water, but electricity is out in some homes, including this man's.
We're sitting here on a keg of dynamite, and we can't go repair anything because the ground continues to move.
In the past 6 months, many homes in the area are literally falling apart from the landslides. Global news 24 hours a day, and whenever you want it. With Bloomberg News Now, I'm Michael Barr. This is Bloomberg. Paul, Alix, Lisa.
All right, Michael Barr, thank you so much. All right, Alix, OPEC Plus is discussing a possible delay to an oil output increase planned for October. I guess that's following the recent weakness in oil prices?
Yep, pretty much. I mean, when we take a look at, now OPEC is never going to say that they monitor price. Like, we know they're not going to say that, but we know that they actually do. So clearly, right? You know, 70 is where we're looking at some kind of floor. You would have thought, though, that the Libya outage would have given them some space to actually increase production like it wanted to. But now with the rumors that maybe there'll actually be a Libya truce and then oil comes back into the market, that maybe that's not the case. So clearly they're looking and did not enjoy the oil slide that we've seen.
They did not like that. How often does OPEC get together officially?
Oh, that's a good question. I don't know, because delegates meet and chat, and then there's like the official meeting.
Okay. So, but that's kind of when they set their official targets, right?
Yeah, but they got to be talking like all the time.
All the time, right.
With this kind of thing. But
chat, maybe.
But I keep reading all the time too that this is not necessarily a fun. I mean, yeah, there's weakness, but the degree to which oil fell did not reflect the degree of fundamental weakness at the end of the day. So there was clearly some other selling going on.
WTI crude oil, $71 a barrel, up about 69 cents today. Brent, $74.37, but certainly on the low end of recent trading range. We'll keep an eye on that because Alix likes oil.
I do.
This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Futures falling after U.S. manufacturing data came in light and showed an uptick in prices paid. Today, we'll get a read on trade balance, factory orders, durable goods orders, as well as JOLTS job openings. Later this afternoon, it's the September Beige Book. Now, on the housing front, U.S. mortgage rates fell last week to the lowest level since April 2023, 6.43%. There you go, Paul.
Not good enough.
30-year
Not
fixed
good enough
mortgage.
for Paul.
Still not in your range.
Not there.
That's all right. That's all right. But what it did, it also sparked this pickup in the MBA's index of home purchase applications. All eyes, though, still on Friday's August jobs report. So we have NASDAQ futures down 0.7%, Dow futures down about 0.1%, S&P futures down 0.4%. We have the 2-year yield 3.83%, down 3 basis points. A yield on the 10-year 3.81%, down 1 basis point. To earnings we go. Shares of Dollar Tree down 12%. The company cut its net sales forecast for the full year. Then on the flip side, you have Dick's Sporting Goods. They're up 0.5%, raised its full year forecast for sales and earnings, and that's really good news. You had Foot Locker slump last week. Lululemon Athletica reported slowing sales in North America. After the bell, we'll be on to Hewlett-Packard Enterprises. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene here this morning. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Just looking at an email that just popped into my inbox from Torsten Slock. If AI is having such a profound impact on call centers, telemarketing, and other business process outsourcing jobs, then unemployment in the Philippines and India should be moving higher. But that is not what the data is showing. So he sees actually some unemployment rates in India and Philippines remaining very low.
Meaning that the robots aren't stealing our jobs
The
yet.
robots aren't stealing our jobs. I don't know how to play that, but that's an interesting data point. And Torsten every day comes in with something that I can use here. Anika
awesome.
Gupta joins us here. She's the Director of Macroeconomic Research, Equities and Commodities for Wisdom Tree. Anika, what do you make of this market here? It seems like we have a pretty solid earnings background. We have a pretty solid economic outlook. We've got a Federal Reserve that looks like it's poised to cut rates. How are you guys at Wisdom Tree talking to your clients about where they should be getting some exposure to this market?
Yeah, I think you've put it quite succinctly, where we are seeing resilience in the U.S. economy, and I think the key turning point is there's good news ahead. We are likely to see monetary easing and a convergence by some of the major central banks taking place, and that's going to be positive for equities on the whole. I think the key bottleneck, as we've seen overnight, is there still remains plenty of uncertainty on the markets. Obviously, we have the all-important jobs report this Friday, and the view is that we should see an improvement from the prior month, as there were a number of one-offs that took place in July, and in comparison in August, we should see some strength coming through, which should pave the way for a 25 basis point rate cut.
So does that mean you got to buy the dip in equities then, from what you're saying?
Well, September is a very, very tough month for equities, as we've seen historically. So I would still be quite cautious. But I think where what equities are presenting is under discounted, and parts of the market that are trading at a valuation discount do still look attractive. For example, as we're seeing the yield curve disinvert, segments of the market such as small cap and value are looking interesting again. But in this disinversion that's taking place, the long end of the curve is likely to stay where it is. And hence, our famous well-known Mag 7 longer duration growth-oriented stocks are unlikely to benefit symmetrically in comparison to value and small cap segments of the market.
So I'm looking at the yield curve here, Anika, and it's pretty much uninverted. I mean, we got the 2s and 10s kind of right in line with each other. What does that tell you?
So that obviously we've seen that play out over the past few months, and that is a complete reversal from what we've been accustomed to over the prior 2 years, which was the yield curve being inverted. So take, for example, a sector like financials. They stand to benefit in a big way because they're going to be lending at a much lower rate on their deposits. They're going to be paying a much lower rate on their deposits, and yet at the same time, because the long end is going to stay relatively where it is, they're going to be paying much less on these, or they're going to be receiving the same amount on those loans. So hence their net interest margins are at an advantage. So financials stand to benefit from that change. Small caps, again, the sector most sensitive to the shorter end of the curve, again, stand to benefit in comparison to what we've seen over the prior 2 years. So, what that tells us is, as we've now gotten to the point where the yield curve has disinverted, those segments of the market that did get penalized, over the prior 2 years now stand to benefit from this opportunity.
Yeah, I'm also like, is it another fake out like with small caps? Like we get there and then all of a sudden in a couple weeks we'll be back down with a spread of 15 basis points. In your previous life, you were also an equity and commodity strategist. So I wanted to get your take on what you thought of what's happening with oil right now with WTI breaching 70. Is that a fundamental issue, or was this just sort of caught up in the financial flows that we've seen over the past couple weeks?
I think the price of oil is essentially reflecting what's happening in China. We aren't seeing a big bounce taking place in China. We haven't seen a lot of strength in the demand for oil coming in from China. And I think that's what it is actually reflecting. It's also reflecting concerns over global growth, that 50-50 dilemma of whether we get that soft landing or that much protracted slowdown in global markets. And I think as that, manifests, and we at WisdomTree believe that it'll be more of a slowdown as opposed to a protracted, decline in global markets. We will see oil prices recuperate. And the other big thing is, I think markets are discounting geopolitical risks in a very big way. Yeah. We still haven't got that ceasefire that Israel is, the people of Israel are demanding. There's plenty of geopolitical risks, and oil and gold are the two commodities that stand to benefit in that environment.
Gold's had, as you mentioned, just had a great run here. What's your thoughts here on gold? Is it just, again, still the harbinger, a little bit of safety here?
So it's a number of factors. It's clearly, China stands to be one of the big drivers of gold prices going forward. First and foremost, the domestic Chinese investor isn't putting their money into real estate because real estate isn't doing so well. So they're actually putting their money in another safe haven, which is gold. At the same time, we've had the central bank buying up gold in its reserves, and we will be getting further confirmation of whether that is increasing or not. Other central banks, such as China, such as India, as well as Turkey, have also been buying up gold. So there's a lot of support on the physical market in addition to speculative buying of gold. Now, obviously, with the Friday jobs reports, coming into picture, it's going to be a tale of two events. If we see a much stronger jobs report, gold is likely to have a bit of a sell-off. However, if we get a much weaker print, that paves the way for a sharper pace of rate cuts, and that becomes a very important tailwind for gold.
What do you think what do you think the market reaction function will be on Friday? Right, so that's kind of a setup going into this. Are we going to see like a redux of August when it comes to the jobs number Friday?
Well, it's very possible. We've already seen the market on tender hooks overnight, and it's echoing what we tend to get September every year. And obviously, equities are really dictating a very different market to what we're seeing in bonds. Bonds are actually predicting a much deeper slowdown, and equities are shirking it off and saying, no, the market is doing really well. Let's keep going. And so the jobs report is really important because obviously, Fed Chair Powell has made it quite amply clear that they are going to go ahead with rate cuts, but the magnitude is still going to be in the pace of 25 basis cuts. So if we do get that bigger, a much weaker print, which the market is not believing, that could result in a bigger sell-off.
Anika, thank you so much for joining us. Really appreciate getting your thoughts here. Anika Gupta, Director of Macroeconomic Research, Equities and Commodities at WisdomTree. She's in London. Literally, their offices at WisdomTree are right around the corner from the Bloomberg headquarters at Queen Victoria Street. I've spent some time there at the WisdomTree folks. Good people over there. Good analysis there. S&P 500 off 0.5%. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Futures falling after more economic data, renewed worries on Wall Street. Yet yesterday's reading of U.S. manufacturing activity showed the fifth monthly decline in a row. Oil dropped more than 4% right now. This morning we have WTI crude at $70.81 a barrel. Brent crude $74.18 a barrel. We have Nasdaq futures down 0.7%. Dow futures down 0.1%. S&P futures down 0.3%. The two-year yield at 3.83%. That's down 2 basis points. A yield on the 10-year 3.81%. That's down 2 basis points. To currencies, want to point out Japanese yen up 0.3% at 144.96 against the dollar. The sell-off in Nvidia shares, it continues. The stock down more than 1%, and this is after shares dropped 9.5% yesterday, wiping $279 billion off its value. Sources say DOJ sent subpoenas to Nvidia. Other companies, it's looking for evidence that it violated antitrust laws. Other companies making news. OpenAI, its CEO Sam Altman plans to spend tens of billions of dollars on AI infrastructure in the U.S. And finally, Volkswagen. It's defending its plans to consider closing German factories, saying that it's flagging sales left at about 2 plants too many. Shares down more than 1% in Germany. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene here this morning. I'm Paul Sweeney. We're live here in the Bloomberg Interactive Broker Studio, streaming live on YouTube as well. You know, you look at NVIDIA's stock, it's up 118% year to date, but it's down 17% from recent highs. There's definitely some issues here. The numbers have certainly been fantastic coming out of NVIDIA quarter after quarter after quarter, but now there's some regulatory issues. The Department of Justice that, taking a look at NVIDIA and some of the other chip makers as it relates to AI. Mandeep Singh joins us. He's our senior technology analyst for Bloomberg Intelligence. He joins us here in studio, unlike his management team, which tends to just mail it in. Mandeep, thanks so much for joining us here. How big of an issue is it for NVIDIA with this Department of Justice issue?
I mean, look, we've seen that with all of big tech. They've been subpoenaed for some reason.
Yep.
We saw that with Google. They, in fact, lost the case for monopoly. Apple, Meta, all of them. And anytime a market, is kind of set up in a way where one company has a virtual monopoly, in this case, NVIDIA has a virtual monopoly when it comes to GPUs, they're bound to get attention, both from their competitors as well as from the regulators. And right now, the question that they are looking at is how has NVIDIA allocated their chips in a market that everyone knows is undersupplied? There is more demand for NVIDIA chips than they can supply. So how have they allocated it? Is there a preferential treatment for the hyperscalers, who are some of their largest customers, or some other companies? And I think that's being investigated right
So it's like surge pricing, but for the hyperscalers, basically, right? I mean, is that what we're talking about? Isn't that just a straight up supply and demand thing?
Well, so if you go back in time, we haven't seen such spike in, buying behavior when it comes to hyperscalers suddenly raising their capex by 50, 60% and procuring all these chips. So maybe one theory is NVIDIA is asking their customers to buy more, otherwise it would supply to somebody else. So in this case, hyperscalers don't have a choice but to buy more. And again, look, nobody knows the real deal. We know SMCI is under a kind of pressure from Hindenburg Research, calling their accounting. SMCI is a customer of NVIDIA. They get chips from NVIDIA. So all this, again, we can only speculate what's going on. But clearly, in an undersupplied market, there is this dynamic that kind of comes to the fore is how is NVIDIA allocating the chips?
So when I look at NVIDIA, I look at a company that it seemingly to me, it just came out of nowhere 18 months ago. I didn't even know this company existed and before 18 months ago when people started talking about AI. But it seems like a company that's grown organically.
Yeah.
And they had a different, maybe better chip than a lot of the competitors like Intel. So they just kind of grew organically. It's not like they made acquisitions and gobbled up the market. They just had a better mousetrap.
They did. They clearly have some IP. Although, talking about acquisitions, they have made a tuck-in acquisition of a company called Run AI.
Okay.
Even that deal is pending. It's not closed because what NVIDIA is trying to do is it's trying to move up the stack Basically, it just provided chip. Now it has a software layer called CUDA. It's trying to buy even more software to deploy these foundational models. And all this kind of strengthens their moat. At the end of the day, it makes it hard for an AMD or an Intel to come up with a better chip that can replace NVIDIA. So it's about vertical integration. I mean, think of what Apple did over the years. And that's what I think NVIDIA's playbook is here.
And then based on the DOJ investigating, I would assume, and you have one acquisition pending, that any kind of M&A with them would be off the table for NVIDIA at this point.
Absolutely. And what these companies, all the big tech companies have been doing is taking minority stakes. I mean, it all started with Microsoft taking a stake in OpenAI, then Inflection AI, Google taking a stake in Anthropic, Amazon taking a stake in Anthropic. NVIDIA, I mean, there were some sources that were saying that NVIDIA is planning to take a stake in OpenAI. So all these minority investments suggest, I mean, remember, this is a B2B business. So NVIDIA's customers are Microsoft. Microsoft is using its chip to train model for OpenAI. So it's very intertwined. It's all B2B. And that's where you could argue, is there some preferential treatment in terms of how Microsoft is even allocating their cloud capacity to OpenAI? I mean,
is that valid? Do you think that's happening?
It definitely is. I mean, Microsoft has a 49% stake in OpenAI, and it's the largest cloud provider with these NVIDIA chips. Who do you think is using chip capacity on Microsoft? It's OpenAI to train their models.
See, I need a flow chart to
just
kind of let me
know
who's doing business with. So get one of your minions to kind of
and
put
I think that's why it garnered that antitrust regulator scrutiny where, I mean, it's a handful of customers. NVIDIA's customer base isn't very large.
Right.
Yes, they've talked about sovereigns, but the bulk of the customers, 45%, is still hyperscalers.
So to the broader point of the sell-off, though, why is that happening? Because we were already there before, right? Before the DOJ headline even crossed. Like, what's up?
I mean, look, with NVIDIA, they reported last week, the guidance was slightly conservative, although it was a clear beat and raise. There was some rumors of a chip delay, Blackwell, their next architecture getting delayed. And for a stock like this, when you're trading at 35 times forward PE, you need everything right. You're priced for perfection. And that's where, even though it was perfect quarter, but still you want the estimates to keep going up. And right now it feels like estimates will be more sideways. There was some risk around gross margin. We have reached peak gross margins for NVIDIA in this cycle. So even 100...
Their gross margins are like a lot, right?
Yeah, but yes, they are over 75%. But when it comes to earnings revisions, all these things matter. The top line momentum, the gross margins, because that's what drives earnings estimates.
SPLC function on the Bloomberg terminal, supply chain. So you go NVIDIA, NVDA, type it, put a little yellow button for equities, SPLC, supply chain. NVIDIA's got 752 customers, but the customers are Microsoft, Meta, Supermicro, Alphabet, Amazon, Dell, names you all know and love. NVIDIA is, I guess, again, I didn't know this company 18, 24 months ago, but they're right smack in the middle of Silicon Valley, literally and figuratively, aren't they?
I mean, they are the Cisco of the 99 wave.
I don't know if they like that comparison.
So what happened to Cisco? You mentioned Cisco. I mean,
it's hard to draw parallels because every cycle has got its own nuance. Even though valuation-wise, I could say the enthusiasm is very similar, but clearly, this cycle will not be exactly same as 99, and that's where, you'll have to figure out when will the supply-demand imbalance kind of fix itself, when will the fab capacity get better. All those are variables when it comes to predicting when will this peak.
When we take a look at, say, some of the software companies that are reporting, because now is the time of the bazillion software companies that I don't know that come out and say things. Are they noticing, what are they noticing in terms of AI demand and where the non-Microsoft, Google budgets are going?
Well, so when it comes to software companies, a lot of them are getting disrupted in this AI cycle. I mean, think about how these co-pilots and chatbots will kind of offer a different way to do things as opposed to the traditional click and mouse type of interface. And every company is trying to figure out how much do they have to invest in AI. That's where I feel all the NVIDIA's gross margin lift is a headwind for all these software companies because they got to rent that capacity and they got to pay up for that compute, which was much cheaper back in the CPU days. So we aren't at a point where we can pick winners in the software field, but clearly everyone is investing in AI because they don't have a choice.
And if I asked 10 CEOs, Fortune 500 CEOs, what AI is, I'd get 10 different answers, I think.
I think that's a probably very accurate response.
I can't give you the 10-word definition of AI.
Can you, Mandeep?
I think I'm fairly confident that this wave is all about the foundational models and how you use models for pattern recognition and using
Pattern
that.
recognition.
Yeah, because
Okay.
it goes beyond machine learning. Machine learning was more personalization, that type of stuff. This is more about unstructured data and pattern recognition using
Unstructured data, which is what you get from like Facebook and social media and stuff like that, as opposed to like a database. I learned that from reading his stuff.
So
But
unstructured data for pattern
recognition.
Yes.
Take that to your next cocktail party.
Okay.
That'll work. Mandeep Singh, thank you so much. The pride of Garden City, Long Island, senior analyst technology, Bloomberg Intelligence, with our news in New York City. Here's Mike Barnes.
Thank you very much, Paul, Alex, and Lisa. As Wall Street analyzes the potential economic impact of the next presidency, economists at Goldman Sachs are sounding a warning if Donald Trump returns to the White House. Bloomberg Government's Jonathan Tamari has more from Washington.
They say that there would be a slightly negative impact from a Donald Trump win and a Republican sweep from a Donald Trump win, whether Republicans sweep Congress or not. They are seeing a negative effect based largely on his threats of a significant tariff increase and on immigration restrictions that they say would, slow down the labor force.
On the other hand, Bloomberg Government's John Tamari says the Goldman team sees a slight boost to the economy if Kamala Harris and Democrats sweep in November. The bank's economists say new spending and middle-class tax cuts would slightly offset the negative impact of a higher corporate tax rate. The Justice Department has announced criminal charges against Hamas leader Yahya Sinwar and the other militants in connection with the October 7th rampage in Israel. The criminal complaint filed in federal court includes charges of conspiring to provide material support to a foreign terrorist organization, resulting in death. A new Russian bombardment, this one on the city of Lviv, following one of the deadliest attacks since the fighting began on a Ukrainian military training facility and hospital in Poltava. At least 7 people were killed overnight and dozens injured, including children. The Grenfell Tower fire that killed 72 people in 2017 was a result of a catalog of failures by government and the construction industry, according to a long-awaited final report from the public inquiry into the tragedy. According to the report published today, failures by the policymakers, contractors, local council, and fire brigade all contributed to the extent of the disaster in West London. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Alex, Paul, Lisa.
All right, Michael Barr, thank you so much. Alex, I'm looking at this story on the Bloomberg terminal. New York City's top taxi insurer is insolvent, risking transit chaos. American Transit Insurance Company posts over $700 million loss. The insurer is responsible for more than 60% of the city's taxi industry and Ubers and all the black cars and all that kind of stuff. So if those folks can't get insurance, what do they do?
Okay, so this actually caught my eye because this could truly disrupt transit within New York City. Apparently, this company, ATIC, has been the dominant player because they can offer cabbies premiums far lower than other insurers. And you take a look, there's a great chart in this piece that says the market dependence on it. You're looking at like Hereford is looking at, what, 19% of the market? American Transit, 64%.
That's amazing. I didn't even think of that, but I mean, I guess they have to figure that out because that's a big issue here for NYC Transit. Me, I just go in the subway. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got red on the screen, and this is after fears of an economic slowdown sparked a stock market sell-off. It saw the S&P 500 drop more than 2% and the NASDAQ plunge almost 3.3%. So right now we have NASDAQ futures down 0.7%, Dow futures down 0.1%, S&P futures down 0.4%. The two-year yield at 3.84%. That's down 1 basis point. The yield on the 10-year 3.82%, and that's down 1 basis point. And fears about the economic outlook, well, that's also affecting crypto-related stocks. After Bitcoin, it touched a 1-month low. It's now down more than 2.5% at 56,000. You have Coinbase down nearly 1%, CleanSpark down nearly 3%, Marathon Digital down 2%. And it's one of the biggest flops for the PlayStation business. Gamers not happy about it. Sony axed the big budget online game Concord just 2 weeks after its release. The company says players will get full refunds at ADRs down nearly 1%. That is your Bloomberg Business Flash. Paul and Alex.
Now, a look at the front pages. What's making news around the world? Your daily roundup of today's headlines from major publications.
All right, your daily look at the front pages around the world is brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest at ibkr.com/RIA. All right, what do we got here? In the newspaper segment, Lisa Mateo, I know you've got some good stuff for us. What do you got?
We do. Okay, so remember we were talking yesterday about Vice President Kamala Harris said U.S. Steel should remain domestically owned and operated. Well, the Financial Times had this report out. It's reporting that Japan's Nippon Steel has made this pledge to promise the company would be run by Americans. So a few things that it promised. It pledged to appoint a board for U.S. Steel with a majority U.S. citizens. It said the board's going to include 3 independent directors who are U.S. citizens, and that core senior management members would be American. But here's another thing. It also said U.S. Steel would be owned by Nippon Steel North America, so that's a New York-based subsidiary of the company. But then you have the Wall Street Journal now coming out saying U.S. Steel CEO saying the company could close steel mills, likely move its headquarters out of Pittsburgh if that sale to Nippon Steel collapses. So all these things kind of coming together after what Vice President Kamala Harris said.
I mean, yeah. I mean, they lost money for like a decade, U.S. Steel, right? Higher costs, lower prices for steel. Like, it's a commodity cyclical business, and it is really hard.
I mean, other than the name United States Steel, like, it's only an $8 billion market cap company. I get the name, I get the affinity, I get all that stuff, Pittsburgh Steel, but you know, I mean, economics are economics, it seems like.
And the difference is that Cleveland Cliffs has also offered a deal for U.S. Steel, but it wasn't as good as Nippon Steel. So you just wonder if, like, Harris campaign and Biden is going to talk more about that now.
It just seems political. You know, we'll just let it. I mean,
exactly.
The day after the election, neither side will care. Just let the deal happen.
I think that's probably true.
Economics.
Yeah, I'm like, sure.
All right, what do you got?
Do you guys carry around like these?
Okay, I don't like this story, and I don't want to talk about it.
Yes, we have to talk about it.
No, we do not.
Yes, okay, it's in the Boston Globe.
I have one of those.
So you carry around these reusable water bottles, right? But they're like infested with bacteria because you have to think about how. I think I wash it once a week. That's so bad. Like I'll pop it in the dishwasher.
Okay, no, this starts.
But how do you wash it? You need like a little tiny baby hand.
Yes, or you need the little brushes. So the Boston Globe like laid out a plan for you, like what to do. So they say one of the things, the Stanleys, some are dishwasher safe and some aren't, and that's like the most popular one. So some people are popping it in the dishwasher, you really shouldn't. So you need like, yes, the little tiny brush to wash it every day, they say.
All right.
You should wash it with soap
This
and
goes
water every
way
day.
deeper than how you clean it.
Yes.
Why do you even have it? When I was growing up, if you were thirsty, you got a drink of water.
Okay,
you didn't have to hydrate.
Hydrate.
Do you not know me but at all? Do you not see how much water I drink?
I know, but I mean, it's like the kids today, they've got these huge things sitting at their desk, and they're hydrating. I mean, the water fountain's literally 3 feet away. Why do you have this jug of water
because
at
you
your
have to
desk.
keep track of how much you're drinking.
No, you don't.
You
if
have
you're
to drink.
thirsty, then you drink some water.
Okay.
That's how it works.
If you are also taking a mountain of pills and
See,
have
with
esophagitis like I do,
Oh,
you need a whole
esophagitis?
glass of water with every pill you take. So I down like those like 2.5 liter bottles when I take my pills.
All right.
This is a whole other discussion.
Very good. Yeah, don't get me started on these.
You have to
on the water.
half your what is it? Half your body weight in ounces. That's how much you're
It's
supposed to
always
do?
been that way. So what have we done since the beginning of time? When you're thirsty, you drink some water. There you go.
You can't overhydrate though. I read that that's a thing and it can actually cause a physical reaction that's not good. But you can OD
Okay.
on water.
Boy, this is
Just the right amount.
very good.
Okay.
Next.
Taylor Swift. I don't know if your daughter's a fan.
Yes.
Okay, there we go. Okay, so this is the thing. The Dodgers' Shohei Ohtani could have that Taylor Swift effect because, he joined the Dodgers this season, $700 million deal, right? But tourism officials telling the Wall Street Journal he's bringing visitors to Los Angeles as far away from his native Japan. Omni Los Angeles California Plaza, they've been seeing bookings for Japanese visitors jump 30% this summer from Expedia alone.
Wow.
He's made the Dodgers this hotter ticket on the road too. So on the road, people are going to travel to go see. Tour operators are selling packages featuring Dodgers games. And then, if they're in first place in their division, they now get ready for these playoff package getaways. So all this different money kind of going into all the talk about Shohei Ohtani.
I bet that's cheaper than Taylor Swift tickets. Right?
Yeah,
Could
and
be.
Here's the East Coast bias. I haven't seen him play. I'm a
haven't.
baseball fan. I'm going to the Yankees next week. I haven't seen him play. I mean, if you're on the West Coast, you might as well be, you're just, nobody cares, it seems like. But again, Shohei Ohtani here, I know he's huge, and he's a once-in-a-lifetime kind of Babe Ruth kind of player here.
hitter,
But
pitcher, yeah.
boy, if he's on the West Coast, I need to pay more attention, I think.
You
I mean,
do.
All right, move over Taylor Swift. All right.
I know. I don't know if they're going to be doing Shohei
Unless it's
Ohtani.
$2,000 tickets
All right,
in Miami.
so as per Ari from the Bleachers, Shohei is closing in on the first 50 home run and 50 stolen base season ever.
Oh, see,
So how amazing
even
is
more
that?
of a reason.
Exactly. All right, I'll
Even
pay
more.
attention.
I don't
now.
know if he's getting the friendship bracelets though.
That's true, and you
See
can't.
about
Can you
that.
trade them?
Yeah.
I don't know, guys. I don't know. All right, what else are you looking at?
Okay, are you drinking less wine these days? I don't know if you guys were like wine drinkers, but you're switching it up. You are.
I'm into the Barbaresco now. We've been pouring that recently,
so
the
good.
Nebbiolo grape. That's
I mean,
been good.
I drink a lot less than I used to. Let's just put a lot.
You are.
A
Yes.
lot less
No, I
than I
totally-
used to.
Yeah.
Got another issue we need to discuss.
Yeah, exactly. We'll just rack them up. We'll rack them up. They're all
We
probably
got the
related.
water bottle.
Well, here's the thing: because people are doing it, Constellation Brands, they're warning that they're going to write down the value of its assets by as much as $2.5 billion this year. So, I mean, they make Robert Mondavi wine, but they also do the beer, Corona, Modelo. They do those too. They say beer not as well too, but they're saying inflation. Consumers are pulling back. They're saying wine is not an essential item, so people are pulling back.
I wonder if it's also like
from
the
that.
post-pandemic. Did people drink more during the pandemic because they
I
were
think
locked up?
yeah.
I remember
yes,
seeing those
we
stories
did.
back.
Yes,
in
we
the day.
Yes, we did. What else was there to do?
Exactly. And now people are out and about doing stuff. Maybe I don't know.
Yeah, and then people are getting like a little bit more health conscious. Like wine has more sugar and more like.
Well, what
different
everybody's
things.
drinking, at least down at the Jersey Shore bars, are the iced
like the
tea,
white-
vodka,
Yeah,
the
yeah.
the white
The
claws,
seltzers.
all-
The
that is
spiked seltzers.
everywhere.
Yes.
Yes.
Everywhere.
Yeah. It sort of reminds me of sort of the IPA trend and like craft beer, like 10 years ago?
Yeah.
That
it
was
reminds
everywhere.
me of God, what did we have growing up? What
Zimas.
What did the
Zimas! Oh my
Zimas,
gosh!
yeah.
Malt beverage.
The wine coolers,
Boone's
those things.
Farm.
Yeah, wine coolers,
Wine
like the
coolers.
peach
That's
wine
what
coolers.
the girls were drinking when I was
Yeah.
like in high school,
But
college.
now it's the hard seltzers
Yeah.
because some of them have zero sugar. It's
Right,
great.
but they have like really high alcohol content. They're
Do
like
they?
5-6% alcohol content. Yeah. Some are even more. I don't remember wine coolers having that much or Zimas.
No.
God, Zimas. Do they still exist?
No, I don't
No, I
know.
can't imagine.
I don't know, but yes, I did used to enjoy
All right,
this.
that is the newspaper segment with Lisa Mateo. Thank you so much. We went all over the place there.
We did, yeah.
Yeah,
We
all
covered
over
a
the
lot of
place.
stuff. We
Yep.
learned a lot about Alix in a very short amount of time.
Exactly.
which
You're
is
welcome.
Exactly. I mean, looking at the futures here, still a little bit of red on the screen, continuing that sell-off from yesterday. The S&P's off about 0.4%. The Nasdaq's off about 0.7%. Looking at the European markets, the stock 600, the European broad stock market index trading off 1% today. So the Nikkei off 4.2% today. So some sell-off overseas. Looking at the yields, 10-year Treasury sitting there right at 3.81%. How about that? So we'll keep an eye on that. Bitcoin, as Matt Miller likes to point out, it is off 2.75%, 56,600. We're going to have more coming up. This is Bloomberg Surveillance. Some tuning.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Are these stocks under-owned by institutional Wall Street?
A lot of these companies talking about generative AI.
With Lisa Mateo on markets.
Investors just worried about the ongoing sales slump in China.
And Michael Barr with news.
A ship traveling through the southern Red Sea has been attacked.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
All right, Alix Steel in for Tom Keene here this morning. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so head over to youtube.com and search Bloomberg Podcast. That's where you'll find us. A busy hour coming up. We're going to check out with Quincy Crosby, Chief Global Strategist, LPL Financial, get her market call. Libby Cantrill, Managing Director of Public Policy at PIMCO, discusses the 2024 election. How's the big bond house out there in L.A. thinking about this election and the impact on the markets? Shanna Sissel, she's the founder and CEO of Banrion at Capital, offer her outlook on these markets. So a lot coming up in the next hour. Plus, we got some economic data coming out later this morning, which we will cover, of course. Right now, let's kick this hour off like we do with Miss Lisa.
You got it. And futures right now still falling after stocks posted their worst day since the August 5th market meltdown, with the S&P 500 falling more than 2%. Right now, we'll check in with S&P futures down 0.3%, 22 points. We have Dow futures down 0.1%, 71 points. NASDAQ futures down 0.7%, 133 points. Tech hit the hardest. NVIDIA racing $279 billion in a record one-day wipeout for the U.S. stock. Shares down more than 1%. And that trickle-down effect, well, it's also felt in the chip sector. We have Intel, who's also struggling with growing financial issues. They're down about 1%. Chip equipment maker Applied Materials down nearly 1%. Taiwan semiconductor manufacturing down 1%. Even the biggest tech companies that are looking to kind of reshape the economy with AI, they're being affected. We're talking about Alphabet, Microsoft down about 0.5%, Apple down about 1%. Over to the bond market, the 2-year yield 3.84%, down 1 basis point. The yield on the 10-year 3.81%, and that's down 2 basis points. Have to check in with commodities. We have WTI crude. It fell below $70 a barrel. Right now it's at $70.90 a barrel. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We got Alix Steel sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. Looking at the VIX here in honor of Tom Keene, right about 23. This is a VIX that had been down, 12, 13, 14, and then we had that, 4 weeks ago on that Monday, spiked up to over 60. Then it came back down below 20. Here we're at 23. We're going to keep an eye on that volatility and keep an eye on that. Quincy Crosby joins us. She's the chief global strategist for LPL Financial. Quincy, when you see a VIX of 23, given that it's been below 20 for such a long time, does that tell you anything at all?
Well, yeah, of course, it tells you that there's worry in the market. Now, whether or not this was worry over seasonality, that September has a really nasty reputation, and it lived up to it yesterday, certainly. But yeah, it'll climb higher. But the 65 that we saw in early August, that was something, obviously, that the market paid attention to. And the concern was there. Was there going to be contagion? The market's always worried about contagion and then the drying up of liquidity in the market. And then it eased, then suddenly things seemed great. We got through August and it was great. And now we're in September and the question is this going to lead to even a deeper downturn? The S&P 500 stopped right at its 50-day moving average. Does it break it today? Everyone is a technician today.
Oh, yeah.
And watching whether or not, yeah, everyone is. But the fact of the matter is it does send a signal if we break through that. The question is, what caused it? What caused it? Was it folks paying, tuition bills for college or private, elementary schools and high schools? Or was it portfolio managers coming in and saying, you know what, maybe I should start locking in some gains for my annual performance? That I haven't heard anyone talk about that, but portfolio managers, active managers are going to be concerned that maybe, just maybe, we're not going to have that positive end to the year, which we normally do, by the way, in an election year. So all of this combined, and was it the ISM manufacturing report? Did that do it? All of a sudden, that's become a key focus on employment gain, options or prices paid. That could have set the market off as well, because those prices paid went up, not down.
I think it's so fascinating that you brought that up. The portfolio managers, also the private school stuff. I had not even thought of that. Nomura was also saying that the U.S. mutual fund year end actually happens between September and October, and that might also be some selling in relation to that. So what do you do?
Well, if you're in the market, you're going to ride it out, because there's going to be data that will come out suggesting that the economy is okay. A lot of focus now on the service sector, ISM, because that moved into expansion territory in the last report that we had. So the market is now all of a sudden, not only are we technicians, we're all PhD economists, heaven forbid, but the fact is there'll be a deep dive on that in terms of hiring expectations, prices paid. We also have to remember that the minutes that came out from the July 31st meeting suggested that there were, quote unquote, several members who thought there should have been perhaps a rate cut July 31st. The question now is whether or not, and this is the big headline, the big narrative, is it going to be 50 basis points or 25? The market really doesn't want 50 basis points because what it suggests is it's not about inflation. It's about concerns over the economy and the labor market. So that's where we are going. And every day, the market is going to have to adjust. The question is this the big one? We have been telling clients, prepare for volatility this month. But the question is it going to stop now? Is something going to come along and say, well, don't worry about it, as it did in August? Or will we see more decline? ASML, that was interesting this morning, what crossed the tape there. Because what does that suggest? We have been paying attention to ASML, Taiwan Semiconductor, leading us into our markets, right? And saying, well, don't worry about it because look at the demand that they have. And NVIDIA should be underpinned by demand accordingly. That was quite an analyst commentary on ASML.
So I guess that brings into the focus the non-farm payroll data we're going to see on Friday, Quincy. That could probably go to, people's perception of maybe how strong or how fragile this economy is. How do you think the Fed's going to look at the payroll data?
They're going to take it apart because the question is, right now, the consensus is about 162,000 new jobs, right? That's the consensus estimate. And that the unemployment rate ticks down to 4.2. If that surprises to the upside on the unemployment rate climbing to, say, over 4.4, the question is going to be, oh, come on, don't tell us it's about more people coming in, the participation rate is higher, and that's the reason. The market's not going to put up with that explanation. The market is going to be afraid, whoa, history dictates that once that unemployment rate starts ticking higher, it continues to tick higher. The other thing is whether or not, and this is very important, I think, for the Federal Reserve, are we going to see wages ticking much higher? The expectations are wages will inch higher, but it won't be particularly dramatic. If it is dramatic, there are those at the Fed who have said, they've come out publicly and said, I'm not really prepared to cut rates yet. I've got to have more confirmation. That won't be confirmation with them, especially with prices paid in manufacturing higher.
Do you think that Friday could put a 50 basis point cut back on the table?
It could. It surprised us in the past. Why couldn't it surprise us again? It's a big, big question mark, and the market is prepared for it, I think, in the sense that they've been talking so much about the probability of a 50 basis point. It's not much. The most probability is toward a 25 basis point. But the thing is, it has surprised us in the past. It could surprise us again. And if it does, this is not going to be healthy for the market. The market wants a series of rate cuts, all predicated on inflation coming down, suggesting that higher for longer is just simply not warranted, which is a healthy reason to have the Fed cut, but not cut 50 basis points because the labor market and then consumer spending, which is the logical extension, is going to be under pressure.
So then on the fixed income side, given that risk profile, Quincy, in the fixed income, should I just sit with my treasuries? I can get a 2-year treasury close to 4%.
Well, yeah, yes. I mean, you saw the last auction we had, right? That was for the 5-year. The foreigners were coming in and gobbling it up like nobody's business. Not domestic, but the foreigners. And so you saw today the 2-year treasury yield. It inched a bit lower. The 10 inched a bit lower. This is a market that is trying to figure out, is this economy just cooling or is it something deeper than that?
Right.
And unfortunately, you've got to follow the data. And most are in the short duration now.
All right, very good. Quincy, thank you so much, as always, for joining us. Quincy Crosby, she's the Chief Global Strategist at LPL Financial. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Alex, Lisa. An official says Ukrainian Foreign Minister Dmytro Kuleba has resigned. The foreign minister's resignation today came as at least 7 people were killed and 35 injured in an overnight strike on Lviv. The mayor said a child and a medical worker were among the dead. Others are in critical condition. Yesterday, at least 51 people were killed and at least 200 hurt in a deadly airstrike in eastern Ukraine. The strike hitting a hospital and college in the city of Poltava, and Ukrainian forces say it was the work of Russian ballistic missiles. State Department spokesman Matthew Miller said that the U.S. military is constantly assessing Ukraine's need.
We have adapted our policy over time based on changes in the battlefield. We continue to remain flexible and look at changes in the battlefield and adapt and adjust our policy when necessary, something the Secretary has spoken to, and that's what we'll continue to do.
Ukrainian President Zelensky has been urging the U.S. to lift its restrictions on using military aid inside Russia. We're learning more about a horrific random shooting on a train in the Chicago area. Police say a man has been charged after 4 people were killed on a CTA train. Forest Park police say Renee Davis faces 4 counts of first-degree murder. Forest Park Mayor Rory Hoskins.
This was an incredibly unfortunate act, a criminal act, a loss of life that we all grieve for.
Mayor Hoskins says the motive for the shootings remains unknown. Pope Francis has urged Indonesia to live up to its promise of harmony and diversity and fight religious intolerance. The Pope through an interpreter.
The Church wants to increase interreligious dialogue. In this way, prejudices can be eliminated and a climate of mutual respect and trust can grow.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg Paul. Alex, Lisa.
All right, well, here's some news for you. Nordstrom family is offering to buy Nordstrom $23 a share in cash. We broke the news about this like months and months ago that they were thinking about doing this. Now, Nordstrom's quarter wasn't terrible. It wasn't Nordstrom Rack is really starting to outperform as you have the off-price desire from consumers like Alex. But it looks like the Nordstrom family could be making this the real deal, $23 in cash.
Yeah, the problem, though, is the stock's at $22.82. It's like, that's
and
it.
That's all the premium you get.
I mean, that's it. So, I mean, then the stock's trading down a little bit here in pre-market trading here. So I'm not sure how excited the marketplace is about that. But we'll see. Nordstrom's. Everybody loves a good sale at Nordstrom's, right?
Oh,
absolutely.
Yeah.
This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Futures still in the red, and this is after more economic data renew those worries on Wall Street. Yesterday's reading, U.S. manufacturing activity showed the fifth monthly decline in a row. Oil dropped more than 4%. Let's check in with WTI crude right now at $70.50 a barrel. Brent crude, $73.82 a barrel. We head over to the NASDAQ futures, down 0.6%, 126 points. Dow futures down 0.1%, 75 points. S&P futures down 0.4%, 22 points. To currencies, I want to point out Japanese yen up about 0.2%, 145.09 against the dollar. The sell-off in NVIDIA shares, that continues. The stock down more than 1%, and this is after it dropped about 9.5% yesterday. Sources say the DOJ sent subpoenas to NVIDIA, other companies as well. It's looking for evidence that it violated antitrust laws. Other companies making news. You have Volkswagen. They're defending their plans to consider closing German factories, saying flagging sales, well, it left it with about 2 plants too many. We have shares down more than 1% in Germany. And finally, Volvo Cars. They scrapped its target to go fully electric by 2030, and that's because of changing market conditions, customer demands as well. Shares down 4% in Germany. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene here today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. And we're also up in Boston. We started yesterday at noon. We want to welcome our listeners in New England on the all-new Bloomberg 92.9, Bloomberg's and Boston's #1 source for news on the FM dial, Bloomberg 92.9. Politics, the election, it's here. I think we got like 63 days to go or something. I think it's important for global Wall Street, so let's try to figure out what it means for global Wall Street. Libby Cantrill, she joins us. She's a managing director, head of public policy for PIMCO. She joins us here in our studio in New York City. Libby, you were just mentioning how you've been traveling all over the place talking to PIMCO clients. They want to know what you think about the election, maybe what it means for markets. What's been your message?
Yeah, so I would say particularly our non-U.S. clients are really interested in both the election, but obviously in implications, particularly implications for debt sustainability, for the U.S. dollar, and then for taxation. And I think what we've been telling them, is that they really needed to wait until after September, because that's actually when the polling starts firming up. It becomes a lot more predictive in terms of kind of providing some clarity in the race. Now we are in September and there is no clarity. I will just say, I think our message to clients now is that this really is a jump ball. It will likely come down to those 6 swing states that everyone has been reading quite a bit about, particularly Pennsylvania. Pennsylvania is the most important state in our view. There are some themes, though, that sort of regardless of the election outcome are going to be common between the candidates. One is that the deficits are going up regardless. And that's because the Trump tax cuts on the individual side all expire at the end of next year. Maybe some of them are going to be paid for if they are extended. We assume they will be extended, but most of them won't be. And so that will add to the deficit. And then also importantly, and I think people sort of forget this, but if you just look at sort of the base case scenario under the CBO's estimate for the nonpartisan budget scorekeeper in Washington, I mean, deficits are just structurally high because of entitlement spending, because of Medicare or Social Security. These are really important programs, but they're also really expensive, and neither candidate is going to reform those. So I think the main takeaway here is deficits are going up regardless of who's actually going to win. And then we also think the direction of travel on tariffs is also clear, and export controls and sort of some of this protectionism. Of course, there are going to be shades of gray. Trump most likely sort of more draconian than Harris, but still, again, direction of travel here is clear.
Do you think that any of this is yet reflected in the market? I keep obsessing about the low tax and high tax companies to see if there's something there within this, and just nothing.
I would say that the only time we really started seeing this actually priced in the market was that very short period of time in early July when it did look like after the debate and after the assassination attempt of former President Trump, that the odds would be a red Republican sweep. That's when you started seeing sort of the term premium reinsert itself in the U.S. yield curve. You started seeing some of the sort of sector differentiation, but all of that basically has kind of collapsed, has gone away effectively as this race has basically tightened and gone back to really where it was in the spring, which is again just a jump ball.
How about down ballot? What happens to two houses of Congress. What's the thinking
Yeah.
there?
Well, so, and I used to work in Washington. I used to work on the Hill. So I have a bias towards really focusing our clients on the importance of Congress. But I really think from an investor's perspective, what happens down ballot is just as important as what happens at the top of the ticket in many ways, particularly from a fiscal policy perspective, tax and spending. Again, I think it's going to be very close. This is really unsatisfying, I realize. And we're not just trying to punt on not making a call. I really do think it's going to be very close.
We're talking about the Senate?
The Senate and the House. I think that the Senate right now controlled by one vote by Democrats. The Senate map for Democrats in terms of the number of seats that they're defending, much more difficult than for Republicans, and so very likely, possible that the Democrats hold their majority, but unlikely at this point. So likely that the Senate flips, but again, by probably just one vote. So that actually has implications in 2025, and then the House. Again, maybe the House flips from Republican control to Democratic control, but regardless of actually who wins, it's going to be a very narrow majority. And what we have seen this session of Congress is that when you have a narrow majority of, particularly when you have divided chambers, but even if you have a Republican or Democratic sweep, it is just difficult to get a lot done.
So exactly.
Exactly. Yes.
So then to that point, does it even, I'm going to get a lot of hate mail from this. Does it matter who's in the White House?
I mean, it does matter, and particularly, I just can't underscore. Everybody just needs to buckle up for next year. It is going to be a tax palooza, if you will. There will be because of all of the individual tax cuts on the Trump tax cuts from 2017 expiring at the end of 2025. Everything is going to be on the table. The corporate tax rate is going to be on the table. The child tax credit is going to be on the table. Carried interest is going to be on. I mean, everything. So there will be a lot of headline risk. So it does matter because a lot of those things will go the way of the White House in terms of ideology. But outside of that, Alex, and this is what we're sort of guiding our clients to, is outside of the debt ceiling, issue, which will be an issue, sadly, early next year.
It's always an issue, right?
I know. Yeah. Unfortunate, especially if you're a debt investor. And then also tax. I just don't think Congress is going to be able to get very much done, again, regardless of who's in the White House. But the White House does matter, as it relates to many other things outside of fiscal policy, but from a tax perspective, it does matter.
Are our elections going to be this close, like forever? I mean, it seems like the last couple elections have been, you're counting votes, like starting in 2000. Is that kind of where the new world is today?
I mean, it's possible. I think it's really difficult to prognosticate this sort of as super secular, but because of the geographic sort of self-sorting that we've seen in the United States, it has become, and because of our sort of highly polarized nature, it has become, very close, particularly at the top of the ticket. And I do think that will likely continue. I mean, if you just look, since the 1980s, just the number of elections where one candidate has won the popular vote and the other candidate has won the electoral college vote. I mean, it's really quite sort of staggering, and that is just because of sort of the kind of polarized nation of our country. The Senate and the House, I think, are quite a little bit different. The Senate, in particular, just because that is more predicated on which seats are up and sort of the Senate map. But in terms of the top of the ticket, I think this is probably likely to.
But even with the House
constant.
and Senate, it's still going to, well, not right, Senate, but the House is zoning, it's all redistricting, right? Like it's still all.
Yeah, redistricting happens once every 10 years, and we just went through a redistricting period, so that won't happen for another 10 years. But people are, the way that state legislatures are drawing these districts more blue and more red. But I think the upshot here for investors, maybe the silver lining, is actually that this isn't such a bad thing, right? I mean, I think that usually if you just look at how the S&P has fared since 1933, the market actually does better under divided government, under very narrowly controlled government. And that's, of course, that intuitively makes sense, right? We like checks and balances, and so does the market.
All right. We got 63 days to go, more or less. Libby Cantrill, thank you so much for
joining us.
Good luck, Libby. Libby Cantrill is a managing director, head of public policy at PIMCO. Do you think that portfolio managers are bringing her up all the time?
Oh, yeah. No, she doesn't get a break. And then you got to do the aftermath of the election. So I forecast maybe in spring of 2025, she can get a vacation.
No, maybe the first few months of a second year of the administration can be a little bit quieter.
Good. Yeah. All right, we'll see about how this all plays out. S&P, we are down about 0.4% here. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
In the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got red on the screen, and this is after U.S. manufacturing data came in light, showed an uptick in prices paid. That was yesterday. We have more data out today, but all eyes, yes, on Friday's August jobs report. It's expected to show payrolls increase by about 165,000. That's based on an estimate in a Bloomberg survey of economists. Right now, we have NASDAQ futures up down 0.6%, 127 points. Dow futures down 0.1%, 62 points. S&P futures down 0.3%, 21 points. The two-year yield at 3.86%. That's little change. The yield on the 10-year 3.83%, and that is little changed. To earnings we go. Shares of Dollar Tree down 11%. The company cut its net sales forecast for the full year. And Dick's Sporting Goods, it raised its full-year forecast for sales and earnings, but shares taking a turn now. They were higher. Now they're down about 1%. And we'll stick with retail. The Nordstrom family has offered to buy Nordstrom for about $23 a share in cash. That's according to a filing. We have shares of Nordstrom down about 1%. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast, and that's where you will find us. Economic indicators today are brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio. Small firm attentives, big advisor impact. Go to commonwealth.com to learn about your consultative support and technology. Our good friends at Commonwealth, we appreciate that. Let's take a look at this market. I mean, I think we had a good earnings season coming out of Q2. I've got a Fed that I think is going to be cutting rates starting later this month. That seems kind of constructive for equities, but has that already been priced in? Let's check in with our next guest, Shana Sissel, CEO of Ben Ryan Capital. Shana, so what do you think here? I mean, S&P up, 17, 18% year to date. Does that reflect kind of what we're seeing in terms of earnings, in terms of maybe Fed movement here, or is there room to go?
Well, I think earnings have been, relatively good. We've not seen, a stretch of disappointing earnings through this cycle. I think that's supportive of a strong economy. And I think that the Fed is going to look at the things it focuses on, which is employment, employment and inflation, and feel really comfortable that they can take a step back. And it's looking more and more probable that we'll have a soft landing if they maneuver through this correctly, because we do have such strength and earnings have held up just pretty well. So do I think we have more upside from here? That's the question. I mean, how common and how used to it can we be to having 20% market returns year over year? That's just not normal.
Right, which begs the question then, do you sort of sell into any rallies at this point, or do you buy the dip?
Well, it depends what kind of investor you are. If you're a long-term investor like I am, you buy the dip. If you're a trader, then there could be some relative weakness in the fourth quarter, especially as we get through the election. And I think that for that reason, if I'm a trader, I might be selling on weakness and then buying back in as some of the technicals are more supportive. But as a long-term investor like myself, I am buying the dip 100% of the time.
What are you buying on those dips? Are we sticking with kind of the Magnificent Seven, the tech trade, or are you looking for value in what might be a broadening market?
Well, I'm certainly looking for a broadening market. I mean, that's a positive technical indicator. It's very bullish when markets tend to broaden and you see more participation across the board. But yeah, I can't tell you that I'm not buying NVIDIA today, down 9%. In fact, I think there's probably more downside as we kind of get through the news related to their subpoena. So that's stock that I would be adding to some risk assets. I like some of the cryptos. As you know, I'm kind of in that alternative space. So BitB and ETHW are my two go-tos to get crypto exposure. And then Apple is another name. So those are names, again, they're kind of sexy. They're kind of the risk on trades. But then I'm looking at names like Atlas Holdings, which is insurance, and AeroCap Holdings, which is, industrials. So that I think there's opportunities across the board. But yeah, I think that the future still is AI, and when I can buy those names at a discount, I will.
So here's my question about the consumer stuff. So the consumer discretionary, and I take a look at, say, earnings today. The dollar stores, you'd think they do great in this environment. They just can't get it together. And then Dick's Sporting Goods actually raises its 2024 outlook. Are these names that are interesting to you, or do you need some more clarity on the consumer and the economy to care at all about these guys?
So it's really interesting because the guys who are doing the best in consumer seem to be those middle market guys, right? Like the not really high end and not the lower end, which is unusual. You normally in economic cycles see, one of the two parts of the barbell are leading. It's either going to be the really high end stuff, or, as we go into recessionaries and the economy slows down, you see kind of the lower end stuff. But it's kind of the stuff in the middle that's doing okay right now, which I think is quite interesting. If I'm going to look at anything, I'm going to be focused more on the lower end. It's more defensive to me. If we do see economic slowdown, people tend to go down market in their spending. And so that tends to benefit like the Dollar Generals and the Walmarts of the world. So if I'm going to look anywhere, it's going to be there, but I'm going to be very careful about the valuations there because I think overall consumer discretionary is a little stretched. It's done really well throughout. And subsequently, it's not a place that I'm spending a ton of time. I think there's better opportunities value-wise elsewhere in the market.
Shana, just on the alternative side here, I'd love to get your thoughts on the private credit business. It's been such an amazing business to watch develop really over the last, 12 years or so coming out of the great financial crisis. How do you guys think about that? How do you get exposure to that?
So it's interesting because with interval funds, you can get access to private credit, the average investor, and there's private credit funds that are coming out all the time in the interval space. There's 200 plus interval funds, which are semi-liquid products that are regulated under the 40 Act. So the average individual can gain access, but they're not super liquid, and they give access to private credit for investors. We tend to use more of the private fund strategies, LP strategies that have an accredited investor hurdle. We just think there's more opportunity there. And I can only tell you what like the managers we work with say. So say a Pender Capital, which is real estate, private debt, or a Meriwether Group, which is lower to middle market direct lending. And what we're hearing from them is that demand remains extremely high for these non-bank lenders because access to capital remains difficult for small business, small and mid-size businesses. So they're seeing a lot of demand. And when you have a lot of demand, the interest rate environment doesn't matter because you can kind of set your price. And so we're seeing that in private credit. I do think in private credit, what you need to be is very particular about where you're playing. There are areas of private credit that I think are very overbought, particularly the upper tiers of direct lending, mezzanine, and some of these huge players that raise billions and billions of dollars. Where you see the most money flow tends to be the area where you lose the potential for alpha. And so looking at smaller boutique players and people who are playing down market are the places where we're seeing the most opportunity because those markets are most difficult for businesses to tap capital-wise.
What do you make of the NFL approving private equity investments? Like, is that something you're into?
Totally into it. So now you're speaking my language because I am a massive sports fan. I grew up in a household where...
It's not my language, though, but I'm trying.
Yeah. So for me, I grew up in a household where on Saturdays and Sundays, if you wanted to watch TV on the one TV we had, you had to watch football because you had no other choice. My dad and my brother, that's what they watched all day, every day. And you just had to either join them or you just couldn't do anything. So I grew up watching football. I'm a huge football fan. I think this is a big deal. I think the democratization of sports is a major development that we're seeing super early. There's only a handful of sports rights funds out there and even fewer that were approved by the NFL. But the NFL is the last of the professional sports leagues to allow for private equity LPs to invest. I think that overall, this just makes the market for sports and the market for investing in sports even broader and brings more interest into the space.
All right, Shanna, I got to ask you, who's your team in the NFL?
I'm from Boston, so I'm a massive Patriots fan. In fact, my fantasy football league team name.
Uh-oh, we lost you kind of there. Okay.
We hung there. We were waiting for it.
My fantasy football team name is Just Add Mayo.
Okay, very good. Shana, thank you so much. We appreciate it. Shana Sissel, CEO of Ban Ryan Capital there in Boston. And we want to welcome our listeners in New England on the all-new Bloomberg 92.9, Boston's #1 source for news on the FM dial. Bloomberg 92.9. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Alex, and Lisa. Democrat Kamala Harris is getting ready to roll out another plank of her economic policy with a focus on small business startups. Bloomberg Government's Jonathan Tamari has more from Washington.
She's talking about increasing deductions for startup costs for small businesses, raising the limit from $5,000 to $50,000. This is something a number of Democrats have talked about. It's something that sounds pretty popular when you talk about small businesses. Democrats have been very critical of large corporations, but this is their way of saying that they want to help smaller individuals or smaller businesses. Both Trump and Harris are trying to roll out what they say will help people deal with inflation and rising costs and boost the economy, which is always a central topic and is again this year.
Bloomberg Government's John Tamari reports Harris will talk more about her latest proposals in a speech in New Hampshire this afternoon. Meanwhile, Republican vice presidential candidate J.D. Vance countered Harris's economic plan.
Let's laugh at the fact that Kamala Harris is promising to do something if the American people give her promotion that she hasn't been doing for the past 3.5 years as vice president. This is the lie at the heart of Kamala Harris's campaign.
Vance made his comments on Fox. It's taken 7 years to produce, finally, the findings of the devastating 2017 Grenfell Tower fire in London, which killed 72 people, has been released. In the long-awaited report, the deadly high-rise fire was the result of decades of failure by successive governments and the failure of the construction industry to act on the dangers of flammable materials on such buildings. Reporting cites that systematic dishonesty of firms who made and sold the cladding and insulation of Grenfell went up like a candle. The Department of Justice has unsealed 6 charges against a Hamas leader. It is for financing and directing attacks against Americans, specifically those killed on October 7th. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Alex, Paul, Lisa.
Hey, Michael Barr, thank you so much. We appreciate it. Looking at some news, Alex, Lyft laying off like 1% of their workforce. I don't understand how those Lyft and Uber paths and fortunes diverge so greatly. I mean, one's 10 times the size, Uber's 10 times the size of Lyft. Is it just Uber Eats? I mean,
or is it just first mover advantage, and then you just get the loyalty? But Lyft, apparently, this is about its bikes and scooter operation.
Right.
And they're going to dispose of some certain assets related to those transportation modes. I don't even know they had those transportation modes, which says more about me probably. So that restructuring charge between $34 and $46 million, and then in asset disposals, they're looking at upwards of $42 million, and the rest is going to go to severance and advisory fees. But this, just to your point, shows how much pressure that Lyft is under in relation to Uber.
Lyft, $4 billion market cap. Uber, $150 billion market cap.
And Uber just going to the bond market today with a huge issuance.
First issuance, right? Yeah. I think the first issuance. And after 29 issuers yesterday in the corporate bond market, 14 today, it's just been a bonanza in the new issue market for corporate debt. So just extraordinary, taking advantage of a little bit lower rates here and the expectation that rates will go lower. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. More economic data out this morning. The U.S. trade deficit had widened to a two-year high in July to $78.8 billion. That's thanks to a surge in imports of goods. Companies also making sure they have enough supplies ahead of a possible dock worker strike. So right now, let's get to the market reaction. We have NASDAQ futures still down about 0.5%, 101 points. Dow futures, little change, down about 35 points. S&P futures down 0.2%, or 14 points. We have the two-year yield, 3.85%. Down 1 basis point. The yield on the 10-year, 3.83%, and that is little change. Fears about the economic outlook also affecting crypto-related stocks. And this is after Bitcoin touched to a one-month low. It's now down about 2.5% at 56,000. You have Coinbase down nearly 1%. CleanSpark down more than 2%. Marathon Digital down 2%. Uber, you heard it. Yeah, it's kicked off its first bond sale as an investment-grade company. Sources are saying it's looking to sell the bonds in as many as 3 parts. Uber shares little change this morning. And Walmart, they're trying to attract sneakerheads. Yeah, it's teaming up with sneaker marketplace StockX. It's going to offer on its website everything from Nike Air Jordans to sneakers from New Balance and Asics at Walmart. Okay. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciated the news you can use, right, Lisa?
But are they also offering the sneakers with the stiletto heels?
I don't think that's on there.
Okay.
Sneakers with stiletto
Did we not talk about this
We did
before?
not.
Oh, yeah. No, I'm super
thought they
into
were the
it.
Crocs.
And I totally want them. Doesn't matter. Just sneakers with stiletto heels.
Really?
I'm all in on
All right,
this.
Check that out. Very good. Lisa Mateo, thanks so much. We appreciate that. Bloomberg Surveillance today brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low transparent commissions. Learn more at ibkr.com/bonds. All right, my finance professor, Cam Harvey at Duke, he penned this paper about the inverted yield curve leading to recessions and all that kind of stuff. I don't know. We've had an inverted yield curve for like a couple of years now, it seems like. Although today, the 3.85%, the 10-year, 3.83%. So it's kind of uninverted or kind of flattened. I don't know what the bond geeks call it. I'll ask Lisa
It's
Bromwich
almost
later.
disinverted.
Disinverted.
There you go.
Oh, I like that. Very good. Andrew Szczurowski, he does this stuff for a living. He is a senior portfolio manager, Morgan Stanley Investment Management. Hey, Andrew, what does it mean to you, if anything, that this yield curve, as Alex just told me, is kind of disinverted right here? Does that mean anything to you?
Yeah, look, I think it's the market kind of sending a signal that the Fed's about to kind of embark on this easing policy. You know, I myself have never kind of been a believer in the inverted yield curve being a kind of predictor of recessions. I think there's been a lot of distortions over the last couple of years between monetary policy. We had kind of QE and then QT, and just a kind of a ton of supply at the front end. So I think that the inverted yield curve this time doesn't send the same signal that it's sent in past cycles. But I think the one thing that's been happening, as you mentioned, the curve's been uninverted, and that's been sending investors a signal that, hey, you can actually go out the yield curve now without giving up that same yield that you would have just a year ago or so. So I think that as you extend out the curve, it's getting more and more attractive. And I think that's something that investors should be looking to do with the Fed about to embark on this cutting cycle.
With the Fed about to embark on a cutting cycle, what do I do with my money sitting in a money market fund that's yielding still about 5%?
Yeah, look, there's over $6 trillion that's sitting in money markets. And that's money that, again, not all of it's going to move out the curve. But if you stayed in that money market fund over the next 16 months and the Fed cutting cycle played out as the market's expecting, by the end of 2025, you're looking at a 3% T-bill rate. And by March of 25, you're looking at a 4% T-bill rate. So while you collect that 5.25% today, if you just go out 6 months or so, it's going to be dramatically lower. So I think you do want to be moving out the curve. I think there's a lot of places that you can still lock in. If you like that 5.25% yield today, you can actually lock in over 5% yields without taking any credit risk by going out into the agency mortgage-backed security market. So again, AAA government agency yielding north of 5%. That's a place that investors should be kind of moving to, even if they're worried about a recession. This is a kind of a natural place to go. The other nice thing about extending out the curve is that bonds, once again, as inflation declines, acts as a hedge on your risk portfolio again. And we're starting to see that. You saw it yesterday as equity sold off, bonds rallied. I think that's something that when inflation is moderating, bonds kind of fit in that balanced portfolio much better again.
So I'm just looking at the Bloomberg U.S. MBS index total return, about 3.8% year to date. But I can do a lot better than that in the U.S. corporate high yield market. How do you think about high yield versus maybe, again, some of those mortgages that you were talking about?
Yeah, look, I think that there's kind of, when you look at spreads in high yield, the aggregate spreads are a bit tighter when you look on a kind of historical average. But you got to be, as I mentioned, I think that we're heading for a kind of a shallow kind of slowdown in the economy here. So I think this is a bond pickers market in the high yield market. I think you got to be selective. We think that at the end of the day, you want to be kind of up in quality in that market and wait for spreads to widen out. We just had a kind of dramatic tightening over the last couple of weeks, and then we just saw spreads widen out about 17 basis points yesterday. So I think there's going to be opportunities to kind of move more into the high yield market. I run a multi-sector fund. Right now, we're a little underweight high yield, but it's a space that we're looking to kind of add on dips. And it's a space that we think will remain attractive as yields come down. That's going to be great for kind of companies that are borrowing and have to kind of roll over this debt. But it's something that, again, you got to kind of pick and choose over time kind of where to add. And we think that's a space that will get more attractive as the year goes on.
What's so interesting in August is when we saw the meltdown in equities and that spike in VIX, we saw a little bit of widening out in credit spreads, but not a lot. Not that we'd normally see with a jump in the VIX like that. Are we still seeing it this time with the rollover in equities and the jump in the VIX?
Yeah, I mean, look, we saw it yesterday. And as you mentioned, we had the high yield spreads widen out to almost 400 basis points, and then they tightened into around 325, and then they widened out around 17 basis points yesterday. So I do think that credit markets will move with risk assets at the end of the day with the equity market. But I also think that at the same time, it's if you're a corporation and you had termed out your debt, let's say in 2020, and you issued a 5-year bond, you have to roll that over in 2025. So I think that lower yields are not lower yields are not actually a bad thing this time for corporations. It's going to be something that they're going to use to take advantage and kind of term out that debt once again.
So, Andrew, what do you guys at Morgan Stanley Investment Management, what do you think, or how do you think the Fed's going to proceed here? Are they going to front load some of their rate cuts here, or are they going to be, I guess, more systematic, 25 basis points every meeting or every other meeting? How do you think they're going to do this?
Look, I think that the JOLTS number today is going to be very telling, and even more important is the payroll numbers on Friday. I think the payroll number is going to tell you 100% whether the Fed's going to go 25 or 50 basis points. If we get a weak number, all of a sudden, right now there's about a 40% chance priced for a 50 basis point cut. But the Fed is shifting from a inflation, like a single mandate on inflation over the last 2 years. While they have this dual mandate, they've been solely focused on inflation, to all of a sudden solely focused on the labor market, because inflation's coming back in order. And the one thing that the Fed wants to do is have this soft landing. And so the Fed knows that they're well above neutral. So the Fed's at that kind of 5.25% to 5.5%. At the same time, core PCE has come down from 5.6 to 2.6%. So there's been about 300 basis points of net tightening from as far as the Fed's concerned. So the Fed needs to kind of get going. And at the end of the day, the market, the Fed's policy operates with these long and variable lags. So anything the Fed does today won't have an immediate transmission through the economy. It's going to take some time. And so the Fed's turning this giant ship. It's going to take a while to turn it. I think that when you look at what's priced in for the market, so around 9 cuts total for the cycle, that still puts the Fed funds rate north of 3%, which, keep in mind, the last hiking cycle, we only hiked at 2.5%. So even if we are in a higher neutral rate environment, which I'm not convinced that it's substantially higher than where we used to be, I think at the end of the day, we're talking about where neutral is. And if we have a slowdown, the Fed's going to go through neutral and below neutral. And that's where the value proposition is in bonds.
All right, Andrew, appreciate it. Thanks a lot. Andrew Szczurowski, Senior Portfolio Manager at Morgan Stanley Investment Management. And that's something that I keep forgetting, is that the Fed has long and variable lags to the up and the downside.
Downside, right.
So when they hike, it's a lag. And then when they cut, it's a lag. Now, I wonder how much the market front runs that. And then all of a sudden you get to refi in the 5s, Paul? Or do you have to kind of wait for that to really filter through?
Yep. Yeah, exactly. I mean, the 30-year fixed mortgage sitting at 6.4% here today, so it's a lot higher than a lot of people ever remember. But it's generally within norms over a long period of time. But it's certainly a long way from
2.75% 30-year fix. Oh, have I mentioned that before?
Yeah, I think you might have. Awkward. So as Lisa Mateo and I, we look at the mortgage, the mortgage market in 30-year fixed. every day.
Is Lisa refinancing?
I'm in the market.
Okay.
I'm looking.
Okay.
It's brutal.
So you all love me right now.
Yes,
right?
and there's not a lot of inventory for the Lisa
I
Mateos
know.
of the world.
I understand. All right, coming up, we got a lot opening for you here. We got half an hour till the opening of the U.S. equity trade. We looked at your open a little bit heavy. We're going to break it down with Gina Martin-Adams, U.S. equity strategist for Bloomberg Intelligence, how to manage this market here. We are off the lows, though, in futures. S&P futures off by 14 points. This is Bloomberg.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Apple's still minting more money than God, right?
Geopolitics front and center for global Wall Street.
With Lisa Mateo on markets.
Stocks are coming off of another record high.
And Michael Barr with news.
U.S. Secretary of State discussed the conflict in Gaza.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
All right, coming up this hour, we're going to drive this conversation forward. We got a lot of smart people coming up. Gina Martin-Adams, she's stuck on a train somewhere, but I think we're going to remote in phone-wise with her because New Jersey Transit sometimes just doesn't have it all together.
Doesn't deliver.
One of those days today. You got a disabled train in Maplewood, New Jersey. These things happen. We'll check in with her. Danielle DiMartino Booth, QI Research. Callie Cox, she's at Ritholtz Wealth Management. And Andrea Auerbach, she is at Cambridge Associates. 4 strong guests for this 9 o'clock hour. We're going to finish it up strong. Futures looking negative here. S&P 500 off about 0.3%. NASDAQ off 0.5%. Right now, let's go to Lisa Mateo. Get a Bloomberg business specialist.
You got it. And not the best kickoff for a new month for stocks here. The S&P 500, NASDAQ 100 saw their worst starts of September since 2015 and 2002, respectively. So before the bell, we'll check in with S&P futures. Now down 0.2%, 15 points. Dow futures down 0.1%, 47 points. NASDAQ futures down 0.5% or 95 points. Tech, the hardest hit. NVIDIA racing $279 billion, a record one-day wipeout for a U.S. stock. And that's after sources say it was subpoenaed by the DOJ. We have shares down more than 1%. And that trickle-down effect felt in the chip sector Intel, who's also struggling with growing financial issues. They're down about 2% this morning. Chip equipment maker Applied Materials down nearly 1%. Same for Taiwan semiconductor manufacturing. Even the biggest tech companies looking to reshape the economy with AI, they're being hit hard too. Alphabet down about 0.2%. Microsoft down 0.5%. Same for Apple. Over to the bond market, the 2-year yield 3.85%. That's little change. The yield on the 10-year 3.83%, and that is little change. Commodities, have to point out WTI crude, it fell below $70 a barrel. It's now at $70.24 a barrel. Brent crude $73.62 a barrel. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast here. All right, we've got 500 stocks in the S&P 500.
Mm-hmm.
I think that's how it works.
Yep.
7 of them
So
are in that magnificent 7. How about the other 493? What are those stocks doing? How are their earnings shaping up? What's the play there? Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence. She looks at the entire S&P 500 and then some. Gina, thanks so much for joining us here. How do you think about the second quarter earnings season and maybe what we saw outside of those top 7 tech stocks?
Yeah, it was an amazing season for the 493, as you characterize them, and the first great season for that group since very early 2022. So big sea change in earnings trends happened beneath the headline. Of course, the index at large pretty significantly beat broad expectations, but it really wasn't just the Mag 7. The 493 were expected to produce about 4% earnings growth in the second quarter. They ended up producing nearly 10% earnings growth. And their expectations going forward were very positive as well. Guidance was generally positive. Margins beat expectations. So kind of across the board, a much better season emerged for the 493, which is significantly different than the environment that we've been in for the last year, which was really just about the Mag 7.
Which then begs the question, when you have sort of S&P futures, they're down by about 17 points, without the Mag 7 and without NVIDIA, can the overall index continue to climb, even though the 493 stocks delivered on earnings?
I think it's really tough, Alex. I mean, frankly, the 7 are so big. If the 7 are falling, even with the 493 rising, it's very difficult for the index to make new highs. A good example is in August, the 493 as a group actually made all-time new highs in terms of their price performance, but the S&P 500 sort of topped out right around its former peak. So it very much makes a difference what the Mag 7 do because they're so big. This doesn't, however, really change much for the portfolio manager because the portfolio manager on an active basis is paid to identify where you're going to have better trends emerging, right? So as long as they're not overly allocated to the 7, they can outperform the S&P 500 in an environment where the 7 are potentially underperforming. I think the likely scenario going forward is really that the 7 just stop driving everything. It doesn't, we don't have to see the 7 fall, for example. It would be somewhat unlikely for them to fall in an environment where earnings are still improving broadly for that group. As long as they stagnate, the 493 can continue rising and the index at large can rise in that kind of environment. But you're right. If the 7 are dropping, it's really tough for the index at large to make new highs.
So, Gina, what's been kind of driving the earnings gains that we saw here in the second quarter? Has it been top-line revenue growth? Has it been margin improvement? A little bit of both?
Yeah, it was a little bit of both. Top line did improve at a faster pace than analysts were forecasting by nearly 100 basis points, in fact, in terms of growth year over year. But margins across the board are improving. We actually saw our second consecutive quarter of margin improvement for the first time since early 2022 as well. Margins improved across most sectors with few exceptions. They improved for both an operating level as well as a net income margin level. So margins are certainly improving. Profitability trends are a big part of the earnings improvement, but that's not the only positive story. Revenue also is growing at a mid-single digit pace and slightly faster than analysts had anticipated.
So what does this all mean for the likes of the small caps and the mid caps? And I say it like that because I feel like the small caps have tried to catch a bid and just cannot seem to get it together.
Yeah, it's a great question. Everything that I just cited for you is for the S&P 500. So it has very little to do with the small caps and the mid caps. I think that the situation in small and mid caps is a little bit more mixed. The largest of the large stocks, the most dominant companies, have improved faster. than the smaller cap companies have. There also are some pretty significant sector level differences. Small caps are much more dependent upon financials, for example, while large caps are more dependent upon tech in terms of market cap concentration. So you do have some pretty big divergences. Small cap earnings trends are improving as well, but not as rapidly as large caps and not on as much of a broad-based sense. So I think that that is playing out real time in the price performance as well, where small caps have really struggled to keep up with large caps. Certainly in August also, we saw small cap returns struggle relative to large cap returns, and that is partly symptomatic of what's going on with fundamentals.
Gina, what's screening well for you and your team this year?
Yeah. So in terms of factors and sectors, on factors, very clearly still quality and profitability is performing very, very well, but also low volatility has really popped to the top of our factor scorecard. Low vol stocks generally performed very well globally as well as in the US over the course of the last couple of months, as you would expect in the seasonally weak time of the year. But we've seen some momentum improving for low vol, and the valuations of low vol stocks are still also quite low. In terms of sectors, our sector scorecard all the way back in June started to rotate out of tech towards some other cyclical and defensive plays in the index. Financials really popped to the top of the sector scorecard, suggesting that, we were due for some new leadership to emerge in the index. And I think we've seen that start to take shape over the course of the last couple of months.
Which is interesting then, because you can't look at, as we were just talking about, you can't look at the headline and say, ooh, S&P down, therefore everything's out. Like that rotation's still there. It's just what's leading it. The other question, and I emailed you about this, I think it was last week. So I'm kind of obsessed with how investors are not pricing in any election risk, because one of the areas is that it's most vulnerable are taxes. And you look at low tax and high tax companies, and those indices that you guys price out hasn't really moved.
Yeah. Well, I think when you look at the election probabilities, the election prospects, it's still a toss-up between the candidates. So how do you trade on this theme? And something that we're watching really carefully is in an environment where former President Trump gathers any sort of momentum, you would imagine that the high tax companies may actually experience some lift. We haven't seen that yet. In an environment where Kamala ends up gathering a little bit of a momentum, we might actually see the lower tax companies trade off because they could see tax increases. So we just aren't seeing a whole lot of movement here. We're watching this really carefully as probably the most important election-related issue. But when the candidates are neck and neck and the polls are still pretty tight, it's really difficult to trade on election probabilities.
Gina, thanks so much for joining us. Really appreciate it. Gina Martin-Adams, she's a chief equity strategist for Bloomberg Intelligence, joining us via Zoom. S&P 500 futures, they are off 0.3%. The NASDAQ off about 0.6%. We'll get this market open for you in about 20 minutes. With our news in New York City, here's Michael Barr.
Thank you very much, Paul. Alex, Lisa. Kamala Harris plans to unveil another tax credit as part of her economic policy rollout. A Harris campaign official says the vice president will call for raising the small business tax deduction for startup costs from $5,000 to $50,000. Harris and former President Trump are competing on tax policy, with a slate of tax cuts due to expire next year. Harris will unveil her latest proposals in a speech in New Hampshire later today. Meanwhile, Donald Trump's running mate, J.D. Vance, criticized Harris's economic policy.
This is the lie at the heart of Kamala Harris's campaign, that if you elect her, she's somehow going to be different than she already has been in office, where her policies have caused higher grocery prices, higher food prices, and, of course, a wide-open southern border.
Vance made his comments on Fox. A long-awaited damning report is out on the Grenfell Tower fire in West London that killed 72 people in 2017. The report lists a catalog of government and industry failures in concluding that all the deaths were avoidable. UK Prime Minister Keir Starmer issued an apology in an address to Parliament this morning.
It should never have happened. The country failed to discharge its most fundamental duty, to protect you and your loved ones, the people that we are here to serve. And I am deeply sorry.
Prime Minister Keir Starmer promised to act on the recommendations in the report within 6 months and to take steps to ban the companies involved from receiving public contracts. Foreign Minister Dmytro Kuleba, one of Ukraine's most recognizable faces on the international stage, has submitted his resignation. Meanwhile, Russian strikes overnight killed at least 7 people in the Ukrainian city of Lviv near the Polish border. There's dangerous heat in the western U.S. this week, from Spokane and Portland down to Las Vegas and Palm Springs. It has been potentially record-breaking heat. In Vegas, it will be around 107 degrees for the next 3 days. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Alex, Paul, Lisa.
All right, Michael Barr, thank you so much. We appreciate that. Let's talk Miami Beach. A lot of money going down there, a lot of people going down there from both New York and the West Coast. Look at this. When Andreessen Horowitz opened an outpost in Miami Beach, the $43 billion venture capital giant bolstered the region's ambitions of becoming a tropical tech mecca. 2 years and a crypto meltdown later, that office has been quietly shuttered. I didn't see that coming.
Yeah, do we know why?
I think they're basically just saying, venture capital money flowing to Miami has flagged since 2022. Miami-based companies brought in $400 million in the second quarter, compared with $5.5 billion for 2022 as a whole. That's according to PitchBook data.
That's quite interesting.
By contrast, artificial intelligence boom has given San Francisco even more of an edge as a tech capital. In the second quarter, companies in the Bay Area raised $18.7 billion in venture capital funding.
Also, we've talked about different stories too, that their roads aren't built there to handle the kind of traffic that was coming down. The schools were overpopulated, so I wonder if they had a hard time getting workers to come down there.
Yeah, and I'm just like, all those people flocking down to Miami. In Florida in general, it's great, but you got to live there.
Yeah, I don't want to do that.
Yeah,
you got to pay the electricity grid.
You
got to deal with hurricanes and storms. Well, San Francisco has problems too. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Futures still in the red, and this is after more economic data. Renewed worries on Wall Street, yet yesterday's reading U.S. manufacturing activity, it showed the fifth monthly decline in a row. You had oil dropped more than 4%. Right now, we'll check in with WTI crude at $69.92 a barrel. We have Brent crude $73.31 a barrel. We head over to NASDAQ futures down 0.6%, 116 points. Dow futures down 0.1%, 58 points. S&P futures down 0.3% or 18 points. The two-year yield at 3.85%. That's down 1 basis point. The yield on the 10-year 3.83%, and that is little change. To currencies, pointing out Japanese yen up 0.3%, 144.99 against the dollar. We have the euro stronger and British pound stronger as well. The sell-off in Nvidia shares, it continues. The stock now down more than 1%. This is after they dropped 9.5% yesterday. Other companies making news, Volvo Cars, it scrapped its target to go fully electric by 2030, and that was due to changing market conditions, also changing customer demands. Shares down 5% in Germany. And then you have Volkswagen defending its plans to consider closing German factories. It says flagging sales. It left it with about 2 plants too many. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. FED Go, Fed Go. It's everything you need to know about the Federal Reserve. Data, news, analytics, everything is right there. What I need is just the date for the next meeting, and that's September 18th. Is when we're going to hear from the Fed next. And the expectation is the Fed's going to cut rates. And the question really is by how much and kind of what kind of message do they try to convey to the marketplace. No one follows this stuff better than our next guest, Danielle DiMartino-Booth. She's the CEO and chief strategist at QI Research, former advisor at the Federal Reserve Bank of Dallas, so she knows a thing or two about our Federal Reserve. Danielle, what do you think, given all the economic data that you look at, which is a lot different than the data that other people look at, I think. You look at some really unique data sets. What is the data telling you about what the Fed should do come September 18th?
So we've seen the number of small and medium business closures ramp up to a 5-month high in the month of August. We've seen back-to-back months where announced layoffs were north of 100,000. And that's according to Macro Edge, and they do a great job of job cuts of following job cuts on the Bloomberg terminal. So we've definitely seen an acceleration and amplification in the layoff cycle. I think, however, given what I just said, it all depends on what happens this Friday. We've only got 2 formal scheduled Fed speakers, both of which are Jerome Powell's top 2 lieutenants, John Williams, president of the New York Fed, vice chair of the Federal Open Market Committee, and Christopher Waller, his chief lieutenant. Those are the only 2 scheduled Fed speakers. They are Friday after non-farm payrolls hits. And then, of course, Friday we go into blackout ahead of the FOMC meeting, 2 meetings from today. Mm-hmm. I think that they tell us, broadcast, whether it's going to be 25 or 50 basis points.
Okay, what do you think the jobs number is going to be for the over-under on that? Like, what do we need to see for a 50? What do we need to see for a 25?
Well, I think you could easily have growth in the labor market, and that could skew the unemployment rate lower to 4.2% from 4.3%, and thereby guarantee a 25 basis point rate cut out of the gate. There are a lot of people who have indicated that, hey, you know, I'm trying to be an Uber driver. I'm trying to do anything that I can in the gig economy because my state will only pay me $295 a week, and that's not going to pay the bills. So Anna Wong at Bloomberg, she's done some great work. Recipiency, the percentage of Americans collecting unemployment insurance is down to 25%. That's from 31% at the beginning of the year. So people who qualify to file an initial jobless claim, they're not doing it because they're putting pencil to paper, or they're using their calculator on their phone, and they're like, that's not gonna work for me. So I'm just going to join the gig economy, and we're seeing that in increased numbers.
Danielle, we're starting to see, I pay attention to the mortgage rates out there. Alix does not, because she's got a low mortgage. What's the housing market telling you these days?
The housing market's not telling me enough these days. You would think that we had gone from 7.90% on the 30 rate fixed at its peak in October of 2023 down to 6.4%, give or take, given this morning's release from the Mortgage Bankers Association, that weekly tell. You would think we would be seeing a lot more activity on the purchase side, and we're not. We are seeing a continued inventory build on the FHA side, the easiest mortgages that you can get your hands on in terms of credit standards. We're seeing double-digit plus delinquency rates there, but we're not seeing the kind of activity that you hoped would have been spurred by a 1.5 point decrease in the cost to borrow to buy a home. I would say ditto for car sales. Wards is on the Bloomberg Eco page today, and Wards has come out ahead of this number and said that they think we're going to see a disappointment on auto sales as well. Your second most sensitive to interest rates.
Well, that's a great point, because I wonder how long the variable lag is on cuts to really filter through to the real economy.
And that is the best point that you can bring up. A onesie, twosie, 25 basis point here, quarter percentage point cut here, there. Let's say there's 3 of them in 2024. Big whoop-de-doo. It's not going to make that big of a difference at all. We've already seen 150 basis points of declines in the 30-year fixed rate mortgage, and purchase activity is still pretty much at the lowest level since it was in 1991. So the market is telling you, Federal Reserve, if you want to make a big difference for us zombie corporations that need to refinance for the, 7 buildings that Moody's calculated in the last few months that have traded for at least $100 million in losses for a lot of corporate debt out there. They're all saying, you can give me small rate cuts, but they're not going to move the needle. We need to go back to the zero bound, and then you'll see some activity.
If they were to go more aggressive on the rate cuts, would that be a negative for the market, suggesting that this economy really is in trouble or greater trouble than the market believes?
And therein lies the irony, right?
Yep.
If the Fed becomes aggressive, the Princess Bride, rodents of unusually large size, if we start to see rate cuts of unusually large size, that's not a good sign either. And that just means that unlike the Bloomberg consensus, which is expecting to see a 4.2% unemployment rate, we instead see a repeat of what we have seen in prior cycles. Once you start to see more than 0.1% rise in your unemployment rate, it tends to take on a life of its own and go 0.3%, 0.4%. That's how history typically behaves. Of course, this time can be different.
Yeah, it's always the best phrase. This time will be different. All right, Danielle, thanks a lot. Danielle DiMartino Booth, Chief Strategist at QI Research, joining us there. The rodents of unusual sizes. My husband doesn't like Princess Bride. Did I tell you about this?
No.
And I didn't know that when I married him. And
that
that's
would have been.
And that's a hard thing to kind of stomach at this point. I mean, Lisa feels me. She's.
As you wish.
How do you not like it? It's a thing. It's a thing for me now.
I haven't seen it.
What? Says Alix's really squeaky voice.
Yes.
How is that possible?
I don't know. Do I need to go back and check it out?
Yes.
All right.
This is not a question. This is when it's raining and you can't go to the beach. You go home and you watch it. You come back and report it.
Okay, very good. I got a lot of work to do there.
Yeah, you do. All right, in the meantime, looking at the markets here, we are looking at a lower open. The S&P futures are off by about 18 points. Dow Jones futures off by about 24. And the NASDAQ 100 futures off by 124.
WTI crude oil under 70.
Under 70, but OPEC Plus might rethink adding oil back into the market in October. So clearly not liking that 60 handle there for the oil market. Also seeing a little bit of a bid into the bond market as well, but nothing like we saw yesterday. You're looking at the bond market relatively flat. We got the U.S. Open in just about 5 minutes' time. This is Bloomberg Surveillance.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, some more economic data for investors to look through this morning. U.S. trade deficit widened to a two-year high in July to $78.8 billion. That's thanks to a surge in import of goods. In about a half hour from now, we'll get JOLTS job openings as well as a read on factory, durable goods orders. And then later this afternoon, it's a September beige book. But at the start of the new trading day, let's get right to it. We'll start with the S&P 500 right now, down 0.3%, 19 points at 5,509. We have the Dow, little change, down about 7 points at 40,923. The Nasdaq down 0.7%, 123 points at 1712. Let's get over to the bond market. The two-year yield, 3.84%, down 2 basis points. The yield on the 10-year, 3.82%, and that is little changed. Want to head over to commodities right now. We have spot gold lower, $2,485 an ounce. Brent crude, $73.18 a barrel. WTI crude, $69.79 a barrel. At the open, also want to check in with shares of NVIDIA. They are down 2%. That is your Bloomberg opening bell report. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. We're in your dashboard as well on the Apple CarPlay and Android Auto. So we're pretty much got all the technological bases covered. Speaking of technology, Bitcoin off 3% here, 56,400. I have no idea what that means other than risk off.
Yeah, I think it's that simple. I mean, I think it's risk off. You look at the sectors that are the biggest losers within the S&P right now. You got technology off by 1%, consumer discretionary off by 0.4%, communication services, which is really like an Amazon situation, off 0.2%. But within the S&P, you want to know what the worst stock is?
What?
Dollar Tree.
Yes.
Off by over 11%. I just find this so interesting because if the middle market's getting squeezed and lower income is squeezed, you would think these guys are doing really well, but they cut their profit forecasts for the year and for sales as well.
And then, yeah, Dollar Tree stock is off 12% here, 52-week low, off 50% year to date for a company with a $15 billion market cap. That gets your attention, and again, it just kind of goes to the consumer out there, the bifurcated consumer, the consumer that owns, it seems like the consumer that owns assets, whether it's stocks, bonds, real estate, they're doing okay. They will presumably also benefit from lower interest rates, but those that don't own those real assets, getting stung by inflation. That's been a play over the last two or 3 years, and not that big of an impact from lower interest rates. So that's the big issue out there. That's an issue that I think will be reflected in the election coming up in just what is it, 63 days.
I'm glad you're counting. Countdown clock for Paul Sweeney. On the upside, this is not a shocker here, but you have utilities, consumer staples, and financials as you have a little bit of bid into the bond market. But I gotta say, it doesn't feel like there's a ton of follow-through selling from yesterday yet. I appreciate the Nasdaq's off by 0.7%, but it was down 3% yesterday. So let's just see. Let's just see as we kind of head into the opening for today.
Plus, the big one of the big data points that the market will be looking at, the Fed will be looking at, will be the labor market. And Friday we get the change, and I'll be here Friday. The change in non-farm payrolls, 165,000 is the number, 114,000 last period. The unemployment rate expected to be about 4.2%. Michael McKee joins us because I want to break that down with him and some of the other economic data from this week. Michael McKee covers all the economics for Bloomberg TV, radio, and pretty much everything else. So, Michael, it feels like this non-farm payroll number is going to be pretty important for the marketplace and for the Federal Reserve as they think about what to do on September 18th.
Yeah, it's going to be kind of the major thumb on the scale one way or another. They debate about 25 or 50 basis points in terms of a Fed rate cut on the 18th. The consensus is we return to a little bit of normality, I guess, if you define normality as what's been going on for the last 2-3 years in terms of job creation and unemployment. There's a feeling that maybe we saw some distortions in the July numbers that'll reverse in August. And if that's the case, then the Fed still has the evidence that the economy is doing well, and even though we may not need the rates we have now, we don't need an emergency cut, a big cut, and so gives them hope that they can go on 25, and that'll be the way the market thinks through this.
Is it going to be a Rorschach test, though? Like, see what you make of it? Like, if I already think we're going to get 50 basis points, we're going to get it no matter what the number actually is?
We've been doing that in the markets. The markets have been doing that now for years since the Fed started raising rates. Did they do enough? And now cutting rates, are they doing enough? There are people who think that the economy is weakening rapidly and the Fed should be responding sooner and faster. So that debate's going to go on, but I think the majority of people will price in or retain a price for 25. Now, this will also partly lead into, as will CPI the following week, the question of how much do they do by the end of the year, which is a sort of distinction I really don't get because they have another meeting in January and in March. But we've seen 100 basis points priced in, which implies 50 at some point because there's only 3 meetings left. So does that change based on what we see?
Just looking at the U.S. employees on non-farm payrolls, again, looking for, a positive number. It was 114,000 last month. It doesn't go negative very often. I mean, something's really got to be bad where you get a negative, kind of non-farm payroll number. It has to be a pandemic, or before that, it has to be the great financial crisis. Before that, it's, the early 80s. It doesn't happen very often. What's a reasonable number for the Fed? What do they like to see across the tape every month, do you think?
Well, the idea of just having enough jobs created to absorb new entrants into the labor force is about 100,000. That's fluctuated over the years based on the size of the population and the labor force. But they would be satisfied with that. The markets would not, because, of course, it's the change that the markets watch. And stepping down that far would worry people that the economy is slowing too fast. If we go down slowly to that level, then the Fed and the markets would probably be fine with that, accepting it as the way things should be. But we've grown used to this idea of big gains every month and an unemployment rate below 5% for so long that it's become sort of normalized.
Yeah.
And speaking of, can I just point out, Dow has flipped positive, up 0.2%. Didn't I call this with you, Michael McKee, on email earlier?
and I have a question for you guys, because you're both the stock experts. This was a debate
Not true.
Abigail Doolittle and I were having earlier. All day long, we and others have been saying NVIDIA had the biggest market cap loss ever yesterday. Does that matter? I mean, market caps always go up and down, though, and the more people buy stocks and the higher indexes go and the higher stocks go. So isn't it more important to say the percentage value of a share fell the most or whatever, because that's what I would own and where I would feel the pain.
Yeah, but what's not sexy is saying in a headline, the percentage value of a share was down for NVIDIA. You know what is sexy? $270 billion market cap loss for NVIDIA.
Yeah, and that's real money. I mean, I don't care who you are.
Bloomberg had a story earlier today that said, yesterday NVIDIA lost an Adobe.
Yes.
Right. Oh, I love those comparisons.
I thought that was a good comparison.
No, that's awesome.
That was a sexy one, as you say, even though it doesn't really
mean anything. Yes, exactly. It's called journalism, Mike. Before we get to Friday, though, we get JOLTS at 10. Yeah. So I'm not going to be here because they don't let me do 5 hours of radio a day, but they do let Paul do that. So what does Paul need to know at 10?
Totally unfair. We're anticipating that we will continue to see job openings decline. We've gotten now down to the vacancy rate, basically unemployment versus the number of jobs out there, being at a 1.2% ratio, and that could fall further. And if you get down to about 1%, then you got as many job openings as there are people looking for jobs, and that is what your historically normal situation should be. So that would tell the Fed that the labor market is loosening up some or continuing to loosen up. And again, it's a question of magnitude, not so much direction. We expect it to go down as long as it doesn't drop precipitously.
All right, we don't want that. And real quick, is there an unemployment rate that the Fed I don't know, feels comfortable with, or is there an unemployment rate that if we see something on Friday that would spook them, or do they not
Or
too
just
concerned about the
We used to
magnitude.
think where we are now is way below the natural rate of unemployment, and that has changed a lot. We feel we can get down to much lower rates of unemployment now. The Fed would look to anything above maybe 4.5 as worrisome, and also again the magnitude, the speed of the change to that, because they predicted 4.1% by 4.2% by the end of the year. Now we'll get a new forecast in September, but they'd be looking at that. If it goes below that for some reason, then they're not going to complain.
All right, Michael McKee, thank you so much for joining us. As always, Michael McKee does all the economics for Bloomberg Television and Radio. Appreciate getting some of his thoughts. EcoGo is a really good function to keep you up to date on what all the economic data is coming out and kind of where the street is in terms of consensus, because it moves markets. With our news in New York City, Michael Barr.
Thank you very much, Paul and Alex and Lisa. Israel says it can't leave the border region between Gaza and Egypt, known as the Philadelphia Corridor. Hamas has insisted Israeli troops leave the area as part of a ceasefire deal, but Israeli Strategic Affairs Minister Ron Dermer says the security risks are too high.
The fact is, for the last 20 years, since Israel left in the disengagement, a move that was applauded by the whole world, we left that corridor called the Philadelphia Corridor. We left the border between Egypt and Gaza. We have not had a solution on the ground. I'm not questioning the intentions of the Egyptians. I'm questioning the results. And all of Israel saw it. October 7th could not have happened without that border being open.
Israeli Minister for Strategic Affairs Ron Dermer spoke on Bloomberg Surveillance. With the presidential debate less than 1 week away, both candidates are working to get out their message. Donald Trump is focusing on the border. Vice President Kamala Harris is focusing on the economy with a stop today in New Hampshire. A long-awaited report is out on the Grenfell Tower fire in West London that killed 72 people in 2017. The report lists a catalog of government and industry failures in concluding that all the deaths were avoidable. UK Prime Minister Keir Starmer issued an apology in an address to Parliament this morning.
Mr. Speaker, today is a long-awaited day of truth, but it must now lead to a day of justice. Justice for the victims and the families of Grenfell, but also a moment to reflect on the state of social justice in our country, and a chance for this government of service to turn the page.
Prime Minister Keir Starmer promised to act on the recommendations in the report within 6 months and to take steps to ban the companies involved from receiving public contracts. Global news 24 hours a day and whenever you want it. With Bloomberg News Now, I'm Michael Barr, and this is Bloomberg. Alex, Paul, and Lisa.
All right, thanks so much, Michael Barr. Appreciate that. So, as I mentioned, stocks are flipping a little bit positive here. The Dow Jones Industrial Average up by 0.3%. The S&P now flat. The Nasdaq down by 0.3%, and volume is also pretty strong. So I wonder if that buy the dip will be something that we will see as it plays throughout the day.
Oh, it could be. I mean, I think the expectations, maybe the market certainly, you can always make that call here with the stock market up, S&P up, 17, 18%, then maybe it's gotten a little bit ahead of itself. But if you talk to the Gina Martin Adams of Bloomberg Intelligence, she kind of feels like the earnings have been there to support this move in the market. And the expectations remain pretty solid for earnings across the across the kind of the curve there. And so with a Fed that's about to begin cutting interest rates, one can make the call, a constructive call for higher markets here. So we'll have to see. But looking at the 10-year Treasury, the yield's coming in 3.81% on the 10-year. But I'm going to call that WTI crude oil below $70 a barrel. As someone who fills up the tank once a week, I like that.
No, you like that. I don't know if the financial market's going to like that. Citi had a note out that said, look, we might be close to the bottom, but you won't really get a sustained, meaningful bounce unless OPEC Plus actually cuts more.
Okay.
Not add back in oil, but actually cuts more. And that's going to be a little dicey. I don't know. If weakness continues, you may wonder if that's true. Coming up, Andrea Auerbach is Global Head of Private Investments at Cambridge Associates. She'll be joining us. This is Bloomberg.
hits, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got a change on the screen, a little bit of red and green, and this is as traders await fresh economic figures. We have JOLTS coming up in about just a few moments from now, coming up at 10 o'clock Wall Street time. Right now we have the S&P 500, little change, down about 4 points. The Dow, little change, but up 20 points, and the NASDAQ up about down 0.3%, or about 56 points. We have the 2-year yield at 3.84%. That's down 2 basis points. The yield on the 10-year 3.81%, and that's down 1 basis point. To earnings we go. Want to check in with Dollar Tree. Their shares down 21%. It cut its net sales forecast for the full year, so not so good news there. Dick's Sporting Goods, they raised a full year forecast for sales and earnings, but shares down about 9%. And finally, Nordstrom, some news there. The Nordstrom family offered to buy Nordstrom $23 a share in cash, plans to take the retailer private for $3.8 billion. That's according to a filing, and its shares right now up about 2%. That is your Bloomberg Business Flash. Paul and Alex.
All right, this is Mateo. Thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene. I'm Paul Sweeney. We're here in our Bloomberg Interactive Broker Studio in Midtown Manhattan. Bank of Canada cuts key interest rate 25 basis points to 4.25%. That's matching estimates. So, here we go. This is kind of what you want to see around the world, with I guess the exception of the Bank of Japan here, folks cutting rates here.
Yeah.
We're going to be down in Orlando next month, Commonwealth Financial.
Mm-hmm.
When a couple years ago when we were down there, I was surprised how many financial advisors wanted to talk about alternative investments, private equity, private credit, hedge funds. I'm like, really, your retail clients are interested in that? And they said, yeah, big time. And an allocation is much higher than I had thought. So let's talk about that a little bit. Andrea Auerbach joins us. She's global head of private investments at Cambridge Associates. Andrea, private equity, that's what I grew up with. There's now private credit.
Yep.
There's lots of alternatives out there. But in private equity, nothing's happening. I got no deals. I've got no sales. I've got no IPOs. If I'm a limited partner, I want my returns. I want liquidity. What's happening in the private equity?
Yeah, I think you summarized it. Not a lot.
Okay.
Not a lot is happening right now. Distributions back to LPs are at basically all-time lows when you look at the distribution yield for private equity and for venture capital. And some of that was caused by the end of the zero interest rate environment. Obviously, as interest rates spiked, valuations had to make adjustments, and a lot of owners of private equity assets were not able to sell them for what they paid for them or better.
Yep.
And so there's basically been a full stop for quite a while in the transaction environment.
Does this change when the Fed cuts rates? Is things going to finally start moving, or are we going to be looking at creative ways to pay back LPs for a while?
Great question, Alex. And what I would say is there's been a trickle, not a deluge of exits happening. And so as rates start to come down again, we think that there will be more of an opening of the transaction market. Don't forget, there's pressure on these private equity and venture funds to sell. There's a time limit to how long they can run.
Yep.
So there is pressure. And we are watching some innovations around the forms of continuation vehicles and secondary activity in the marketplace.
Down round, it's a term you don't like. People in your industry don't like having a down round in valuation, but that's the world we're in now. And so have the private equity folks, have they come to that realization? Have they had that come to Jesus moment where it's not the worst thing in the world to come public at a lower valuation than my last private round, or to sell at a lower valuation than my... Have they gotten to that point or not yet?
We're starting to see it, and actually both the U.S. private equity market sort of landed lowest around the same time the public equity markets did back in 22. It took the U.S. venture capital market actually up until last quarter of 23 to finally touch bottom, we would say, as in valuations sort of finally kind of glided, and now they're kind of coming back up. Okay. So we think maybe a lot of the pain has been taken, and hopefully that will result in a little more activity that will benefit investors.
What do you like? Where's the best opportunity that you see?
Well, right now, when we're looking at where capital is getting invested from a private equity standpoint, it's actually been going more heavily into industrials than we've typically seen.
Yeah, I wonder.
It actually, the pecking order right now is industrials, technology, and healthcare. Normally, the pecking order is technology, healthcare, industrials.
Okay.
So investors seem to maybe want.
What do you make of that? Is that a policy situation?
I actually think it's a case of a lot of investors were overserved tech in 21, let's argue, maybe the first half of 22. And I think there's a portfolio rebalancing towards let me offset my tech exposure with some more industrial business services exposure. I feel like that's what we're seeing in the market.
I tell you, one of the most amazing, I've been on Wall Street since the mid 80s, one of the most amazing things I've seen develop is the growth of private credit. And that was a business I was in at the Chase Manhattan Bank. I'd give you a leverage loan and I'd charge the heck out of you and we'd make a lot of money. Now, private credit has really become a growth story in the alternative space. How do you guys view that?
I mean, private credit, and I started as a credit analyst at Prudential Insurance in the early 90s, I'm going to say. So definitely remember what it was like issuing loans at that time when interest rates were higher than they are now, actually, right? And so private credit has clearly risen in interest because interest rates have risen, and so better returns on offer. A lot of dry powders in the space looking for a home right now, and investors have embraced it as a source of return, provided the underwriting is strong and you have conviction in the managers in which you're investing.
So is private credit going to go the way of private equity, and just that there's going to be so much money involved, right? It hasn't been tested to this scale in like severe downturns. I know private credit's been around for a while, but not to this scale. Is it going to suffer the same kind of fade, and is the money going to go to the next cool, sexy thing?
Interesting question. And I would say private credit, to your point, it's been around for a long time, just in different forms, right? Insurance companies used to provide private credit. Now it's private credit funds provide the private credit. And so I think you're right, though. There's been a surge of activity and capital flooding into the space. What we've noticed is that spreads have started to come in a little bit because there's so much capital looking for a home in the private credit space. So for us as an investor, we keep our eye on the quality of the underwriting to make sure we can earn the type of return we're expecting. But it's a great point. And if interest rates continue to come down, then the returns in that space will likely also continue to glide down and may make it a little less interesting for investors that may have other choices that they want to pursue.
If I want to go out and raise a private credit fund, or no, private equity fund, let's do private equity fund, easy. Can I do that today? Is there demand out there? I mean, can I raise capital?
Oh yes, there's definitely demand out there, and fundraising so far in the first half of 24 is about $160 billion. So there's definitely interest and appetite for private equity. It's just a lot harder because if you haven't provided distributions back to your investors, if your returns are suffering a little bit because you've had to maybe take some valuation down, right? It's a little harder for an investor to say, sure, I'll lock up my money with you for 10 to 12 years. But it's still happening, and there are definitely pockets of appetite and interest.
Yeah. In a severe downturn, what do you think is going to happen? Like in terms of the sectors that are interesting, in terms of payouts, like if we get there.
So in the severe downturn, and actually we're sort of in a little bit of one right now, right? So distributions we haven't seen distribution yields this low since the global financial crisis for private equity, and since 1989 when you were at Chase Manhattan for venture capital, right? So in some ways, we are actually at a real low for distributions back to investors. If there's let's say an overlay that with a big macroeconomic downturn, I think what you would see is what you would normally see. Everything kind of comes to a stop in terms of capital activity, and then you've got to check your belongings and see how the companies are doing. And if you're over-levered, you're probably in a bit of trouble. If you're overvaluated, you're probably also in a spot of trouble as well.
That kind of goes to the whole mark-to-market issue, which I think is a scam.
As in you shouldn't go mark to market, or
no,
you should?
they should be marking to market, because I mean I see all these endowments put up these great numbers coming out at 22, and I'm like, wait a minute, where's your 30-40% of your portfolio is private? The market's down 30%.
You're like, oh, it's okay, it's 10 years. It's going to be 10 years. I don't need to mark to market for 10 years. But then at some point, doesn't the 10 years stop? And then
that's why you mark to market, to show the value of it. But anyway, it's a whole nother discussion. Andrea, I'll let you go now, but I won't hold you to that one. Andrea Auerbach, Global Head of Private Investments at Cambridge Associates. I mean, I was sitting there at the Duke board meeting. I'm like, wait a minute, you're 40% into private equity. We just were down 30% last year. You got no pain?
I think it's an excellent point. But then everyone you talk to is like, some other guy is going to be feeling the pain. We have more years left in this. It's okay. We're going to be fine. It's 10 years.
Oh, well, they were right, because next year everything came back, so it didn't really matter. So, all right, good stuff there. You're done.
I am done. I have TV in the afternoon, so it's not like I'm going to go home and take a nap, but I'd love to do that. But I'm done for radio. I'll do TV in the afternoon, and you're going to stay for the next 2 hours. 4:10.
4:10. That's a fantastic strategy there on the program. Good stuff there. We're going to have more coming up. S&P 500 absolutely unched on the day. The Dow's up about 40 points. The Nasdaq's down 50. We'll have more coming up. This is Bloomberg.